Hi, everyone. Good afternoon. Welcome to our annual AAUP Pre-Retirement Planning Seminar. Um, Unfortunately, Jay Walsh sends his regrets. He could not be here today. He had a funeral to attend. So we have a lineup of really knowledgeable speakers who are going to share some very valuable information with you this afternoon concerning your retirement plans. We have Catherine LeBlanc from the Social Security Administration, Pat Victoria, which many of you probably already know from Human Resources, Dr. Johnny Liu from Doctor's Choice. He's going to share information on Medicare and Medicare options, supplemental plans. And we have Dan Sanson and Justin Walsh from TIAA who are also going to speak. So I think the best thing is just to get started, and here's Catherine.
Thank you. Thank you, Mary. Good afternoon. Again, my name is Catherine LeBlanc, and I'm a public affairs specialist with the Social Security Administration. I'm happy to be here with you today. Probably don't know that April is National Social Security Month. So I'm happy to be here today and share our message of see what you can do online with you today. A little bit about myself. I've worked for the government for 32 many years. I've done many different positions with the agency. I started out taking claims from people who were filing for retirement disability survivor. I was a technical expert and a supervisor here in Rhode Island in a couple of the field offices. So now I kind of take it on the road and share my message with you and enlighten everybody about Social Security. I do ask that you hold your questions till the end of the presentation. I might get to your question, but feel free to jot that question down and ask me at the end. I'll also be available afterwards. If you want to ask me a question more privately, I'll stay around for a little while as well. So feel free to jot down those questions and shoot them out at the end, because sometimes there's a lot of information that I cover. And there's a lot more that I could cover, but I know that your heads would just be filling up and nodding over if I gave you everything about Social Security. So I try and give you just the highlights, enough so that you can answer the questions that you have or know where to go to get the answers to your questions. So a lot of times someone will ask a question that benefits many people, so I do encourage you to ask those questions at the end. So what will you learn today? The who, what, when, where, and how. So who qualifies for a Social Security benefit? What benefits are available? When should you file for those benefits? And where do you file a claim for Social Security benefits? And just how secure is Social Security? Now, that's kind of been a hot topic lately, so we'll cover a little bit about that. So let's start out just basically how Social Security is funded. The old joke is, who is FICA and why is she taking my money? My daughter learned that lesson when she got her first paycheck, and she did her calculation on how much she was making per hour and how many hours she worked, and she said, "Mom, there's something wrong with my paycheck." And I said, "What's that?" She's like, "The numbers aren't adding up." Yeah, honey, that's taxes. So Social Security taxes, we used to call them FICA. Federal Insurance Contribution Act is the act that Social Security is based on. And it's a matching system, so a lot of people don't realize that your employer also matches Social Security, much like a 401k. So you contribute 7.65% of your wages into Social Security, and your employer matches that for a total of the 15.3%. Social Security taxes, or these FICA taxes, they help to fund the payments for retirement. Disability has its own trust fund, but it's still taken out of the general Social Security FICA taxes, and benefits for survivors and for children as well. Who pays for Social Security? Right now we have about 173 million workers that are paying into Social Security. That's about 94% of the workforce. The other 6% pay into their own private retirement system. Some cities and towns, Rhode Island, they pay into their own retirement system. But most of the workers right now pay into Social Security. And it's an intergenerational transfer system. the current workers pay for current beneficiaries. So the contributions that you make are paying your parents and your grandparents that you're working for and paying now. It's important to remember there's no private account set aside for you with your name on it like a 401k. This is a contribution act that everyone pays into. The birth rates have played a big part in why Social Security has had kind of a little bit of a rocky history. And it has more to do with demographics than anything else. So we all know the baby boomers started in 1946, continued through 1964. That was the period of time where the birth rate swelled. Since 1964, we've had a drop. So if you look at the way I just explained how Social Security is funded, current workers pay for current beneficiaries. So when these workers from 1946 and 64 hit the workforce, the trust funds were very strong. We had a swell in contributions. Since that time, since 1964, the birth rate has dropped. So we have, right now, we have 5 workers. In 1960, we had 5 workers for every beneficiary. Right now, we have 3 workers for every beneficiary collecting a check. In 2034, we're only going to have an average of about 2 for everyone collecting. So that's kind of driving the need for change. Add to that, the life expectancy has increased. We're living longer and healthier lives. When Social Security was established, the average age for a man who was 65 at the time was only 61. Right now, the average age for a man is about 84 and a woman 86. But we all know somebody in their 90s collecting. 1 in 10 current 65-year-olds will live till 95. So you add together the decrease in the birth rate, so you have less people putting in, more people collecting for a longer period of time. Social Security was never established to support someone for 30+ years, and yet that's what's happening. Right now we have 10,000 baby boomers turning 62 every day. That demand on the trust funds is what's driving the need for change. If nothing is done, if Congress makes no changes at all, starting in 2034, I don't know where 19 came from. So starting in 2034, that's when they will not have enough money in the trust funds to pay out 100% of the benefits, okay? In 1977 and 1983 was the last time that Social Security had sweeping reform changes. So in 1983 especially, we had federal employees, much like myself. We used to pay into our own civil service retirement system. Anybody hired after 1983 pays into Social Security. So that was a huge influx of workers. That was one way that they made a change to help the trust funds, strengthen them a little bit more. So Congress is looking at different ways of doing that. You can go on our website and we have the bills that have been by congressmen that have been presented. Increasing the retirement age again, increasing the contributions to Social Security, all these things have been talked about. Social Security remains to be an avid protector over our trust funds, and hopefully Congress will make those changes that will protect us into the future. So stay tuned for that. So let's switch gears and talk a little bit about why you're here today. We're always looking forward to our retirement. That's why we work. Everybody's dream is to live a long and healthy retirement. But Social Security was never intended to be your sole source of income. It replaces about 40% of your pre-retirement income after retirement. So you need more than Social Security, right? You need private pensions, savings, investments, maybe to hit Powerball. Like that woman in New Hampshire that hit Powerball and didn't want to say who she was. I'll tell you, just give me the money. I don't know what the problem with that one was, but. So how do you qualify for Social Security retirement benefits? When you work, and you pay those FICA tax, they're taken out of your check, you earn credits. Every year, the dollar figure for one credit changes. So in 2018, each $1,320 that you earn gets you a credit. How many people remember we used to call them quarters? Yeah, we call them quarters because you had to earn them in each of the 4 quarters of the year. And that requirement is gone now. You don't have to earn them at any particular time. The first $1,320 that you earn gets you your first credit, the second, and so on until you earn 4 for a maximum of $5,280, gets you your 4 credits. That's all you can earn in a year. There's no buyback. Some people, you know, if they're a little short, they say, can I buy back my quarters? There's no buying back of anything with Social Security. Social Security calculates your benefit based on your highest 35 years. And in your packets, I've prepared packets for you. I should have mentioned this a little bit earlier. Put them on the tables. Inside there is a fact sheet on how we calculate your benefit. So, in my own retirement system, it's the high 3. Some organizations pick the high 5. Not Social Security. We look at all your earnings from the time that you start to work until the year before you retire. And then we index them, so we bring them up to current day dollars. On the second page of that fact sheet, we'll show you the indexing factors, or the rate of inflation. And you multiply your actual earnings by that rate of inflation, and it comes up with the average indexed earning for you for that year. And then we scrape your highest 35 years. And that's how we do the calculation. And actually, the calculation is on that sheet for you. If you would like to do that yourself, if you really love math or you have insomnia maybe, you can try doing that yourself, but we have an easier way for you to calculate your benefit that I'll show you in a minute. Over the course of my career, I was asked many times, when's the best time for me to retire? When should I take it at 62, or should I wait until my full retirement age? Well, unfortunately, I don't have a crystal ball, or else then I'd know when I should retire best. But the bottom line is, what's best for you is not necessarily best for you. There are certain things that you should look at when you're looking to retire. Not to mention the percentage that you would get. So you may want to be ready to retire at 62 and want to retire at 62, but maybe the numbers aren't going to work out for you. Right now, someone whose full retirement age is 66, if they take it at 62, they can still do that, but they take a 25% reduction. So in this simple calculation example, somebody whose full retirement benefit is $1,000 at 66, if they take it at 62, they're only going to get $750. Can you live on $750 if your benefit rate is $1,000? Will you have children in college? Will you still have a mortgage to pay? Another thing that comes into play as well when you're trying to think about whether or not you should retire early is longevity. Life expectancy for you, if you come from a family with great genes and your grandparents lived until their 90s and your parents are already in their 90s living to 100, if you are healthy, if you think that you're going to live much past 82, financial planners say break-even point right now is about 20 years. So if you took it at 62, you're ahead of the game till about 82. And then after that, it maybe wasn't the best financial decision for you to make, but you did live. So I don't know that you lost that gamble or not. If you wait past your full retirement age, and on this example it shows, you gain an extra 8% for every 12 months past your full retirement age that you don't take Social Security. Many people now are waiting and leaving their money with Social Security to get that 8% that it's hard to get somewhere else. You can build it up until 70 and get 132% of your benefit. So that's something else to think about as well when you're trying to make that decision whether or not you're going to take Social Security at which age. Part of the 1983 amendments changed the full retirement age. When I first started with the government, it was 65. Everybody's full retirement age was 65. You could take it at 62, or you could wait. Actually, at that point, you could build it up until 72. So the 1983 amendments changed the full retirement age for anybody born 1943 or later. So from 43 to 54, Full retirement age is 66. And then it gradually increases by 2 months for anybody born 55 through 59. And then it maxes out anybody born 1960 or later, full retirement age is 67. That's when you're going to get 100%. You can see the percentages change as well. So if your full retirement age is 67 and you take it at 62, that 25% reduction has now grown to a 30% reduction because you're taking it an extra 12 months earlier. How many people know that we have a Social Security website? Oh, nice to see. Yeah, years ago, you know, if I had asked my parents how you do business with Social Security, they would say you have to go into the office, right? So in the changing needs of the public, we've established a Social Security online, and there are many things that you can do on there. How many people remember that Social Security statement that they used to get in the mail? How many people are wondering, whatever happened to that, right? Yeah. Well, it's had a rocky history, and I was just talking with Dan about that too, really. We started sending out those statements, believe in 1995, and we stopped sending them when Congress cut our budget. Any ideas on how much they cost to prepare, mail to every worker in the United States? $70 million. So it's a huge cost. Even though we were mandated by Congress to send those out to you, it was a great idea because we're calculating your benefit using 35 years of your earnings, and we weren't even telling you what your earnings were. And that was the purpose of that statement, to send these out to people so that you could check and make sure all your earnings were posted. If you have a year that's missing, how would you know if you're not checking your statement? So that was the purpose, to send these statements out once a year. Check it, make sure everything's good. If something's missing, it's a very easy fix if you have your W-2. But if you don't have your W-2 because you're not looking at your statement, and then at 61 years old you say, you know, I better look at that statement, and you see the earnings from 1985 are missing, will you have the W-2 from 20 years ago? So, or 30 years ago. So that was the intent of the statement. These statements were so popular that when we had to stop sending them out, many people were calling up and saying, how can I get my statement? So Social Security established this online account, My Social Security account, that you could go on there and get your Social Security statement on demand when you needed it. Because a lot of times you would go into your financial planner. If you were going to a financial planner and you didn't have your Social Security statement, you had no idea what you were going to get, that's 40% of your whole portfolio. That's a huge missing piece of information that you were trying to plan your retirement without. So financial planners are one of our best customers. They are our voices for us to let everybody know. This statement is great because if you lose it, you can go on there, you can print it up get it on your phone, or you can print it up and bring it in. Excuse me. So that was the purpose, the main purpose of the statement, and now it's evolved. This online account has evolved to allow you to do other things. With this account, in order to get one, you just have to have an email address, obviously a Social Security number, a U.S. mailing address, and then you have to pass a security question. Has anybody had any trouble passing this or created their account? Had trouble passing security questions?
I have a security freeze on my credit account.
Okay, so that's one of the reasons that you can't create an online account by yourself. But you can always go to an office, show an ID, bypass that, and they will give you a code in order to create your account. Yes? Okay. We had it wrong? Yeah, so sometimes the information that's on your Social Security record won't match. Anything that doesn't match, we want to make sure you are who you say you are. Those questions that we ask, we call them out-of-wallet questions. We don't want somebody who steals your wallet to be able to create an account for you. So that's why the questions are pretty tough. But much like if you have a freeze on your security freeze on the credit bureaus, you can always create an account by going into the office and bypass that. Many things that you can do on our website with that account and without that account. So you don't need an account to file a claim for retirement, disability, spouse's benefit, Medicare. You can do all those things without the account. But with the account, you can do personalized things with your Social Security. If you're collecting benefits, you can order another Medicare card. You can view and print a benefit statement saying how much you're getting. You can change your address. You can change direct deposit. You can get a duplicate 1099. All these things you can do. So much like online banking, we have that. We've applied for that extended validation certificate, so that green bar that goes across the URL, that lets you know that we've applied for extra security, because we want you to know that our website is very safe and we take that responsibility very seriously. Just like online banking, you can go to any bank's website and see all their rates and information about the bank. But in order to get into your account, you have to have another layer of security. And that's much like Social Security's My Social Security account for you. Have that extra layer of security and that extra information that you're allowed to get. When you are ready to file for Social Security benefits, there are 3 ways that you can file. You can file online. You can file over the telephone if you call up an office and make an appointment, or you can file in an office. You can walk into an office if you would like, but if you want to file a claim, I suggest that you make an appointment. Many of the offices are quite busy, so filing a claim, you could walk into an office, say I want to file for retirement benefits, and have an hour wait. If you feel comfortable enough filing online, we want you to know that more than 50% of our retirement claims are filed online right now. If you have questions, we encourage you to call up an office, ask the questions. If you have questions today, ask me. And then once you know all the answers, Social Security's employees are not financial planners. We can't give you tax advice. We can't give you financial advice. At that point, we're just the typists. We're going to answer the questions that you have, but other than that, you can have that information. You can file the comfort of your home, knowing all that. If you, not to pick on the men, but when we used to, I used to take retirement claims, we would have them looking in their rings to see what their date of marriage was. I'm not picking on anybody, though, because it happens to women, too. I want you to know that the claims that you file online are looked at a real person, by a real person. We do have units that all they do is they review all these claims for retirement benefits, and if there's a question, they will contact you with to get the answer to that. When you want to file a claim, you can't file 6 months in advance. That's too early. The most you can file is 4 months before you're eligible for a payment. We're going to ask banking information. All checks must be paid by direct deposit now. We're going to ask if you are currently married or if you were previously married to someone for at least 10 years, because we're going to look into your entitlement on another spouse's record, a previous spouse's record, a deceased spouse's record, or maybe those people might be eligible for benefits on your record. Those ex-spouses' benefits are real popular. We're going to ask if you have any minor or disabled children. If you have a child who is disabled before the age of 22, regardless of their age now, if you're filing for retirement benefits or any benefits at all from Social Security, they may be eligible. Unmarried and not working in a substantial capacity is basic requirements for that. We're going to ask if you were ever in the active military service or reserve time. Sometimes we can give you credit for your military service time. We're going to ask, are you eligible for a pension from work that you do not pay Social Security taxes on? So either a local government pension, a federal government pension, that can affect how much you get from Social Security. And we're going to ask you, what are your work plans when you decide to start to collect your Social Security benefits? Many people don't know that, A, there's a limitation on what you can earn once you file a Social Security retirement benefit early, and 2, what the limits are. You can work if you wanted to file for benefits at 62, say you want to retire, but you wanted to just work a little bit part-time maybe, or maybe you wanted to stay on with your employer for a little bit longer. So there are some rules for that. So say I'm 62. I look good for 62, right? I had a woman say, I'm 62 also. We have that in common. I'm like, ma'am, I'm not 62. So I'm 62, December 31st. I filed for my benefits starting in January. My employer says, can you stay on with us while, help us train somebody? And I say, okay, how much do you think I'm going to earn? So we come up with, I'm going to earn $27,042 $40, just for easy math. So I'm over the limit by $10,000. But Social Security only counts $1 for every 2 that I'm going to go over that limit. So even though I'm earning $10,000, I'm 62, I'm earning $10,000 over what you allow, I can still get payments. We count $5,000 of that $10,000. If my monthly benefit is $1,000 a month, they're going to hold January, February, March, April, and May. The $5,000 excess that I'm earning will then be negated, and I can start collecting my Social Security benefits starting in June, even though I'm earning $27,000. Or I can earn $17,000, start collecting in January, and stop once I've earned the limit. And then I'll still be eligible for checks for the whole year. One rule that they have, and it's only available the first year that you retire, for teachers, you retire in June or May or June, right? And then you don't work for the rest of the year, and you've already earned well over the $17,000, maybe even $50,000, which would not allow us to pay you benefits. The first year you retire, we'll look at a monthly test. So we take the yearly figure, $17,040, and we divide that by 12. And that's the amount of money that you can earn. If you want to work after you retire part-time, you can earn 1/12 of that amount starting in the month you tell us you're retired. So if you're going to work through May, starting in June, you can earn 1/12 of whatever the annual limit is and still collect your checks for every month. The year you reach your full retirement age, the amount that you can earn goes up. This year it's $45,360. That's what you can earn up until the month you reach your full retirement age. Because the month you reach your full retirement age onward, unlimited earnings. So essentially, if your full retirement age is 66, you could retire the month you turned with Social Security, start collecting your benefit at 66, and still work full time and collect 100% of your benefit even though you're still working full time. That's an option for you if you wanted or you needed that Social Security benefit. If you wanted to file in January of the year that you reach your full retirement age, and your birthday, you're turning 66 in June, you can earn $45,000 from January through May and collect starting in January. You take a little bit of reduction because you're collecting it 5 months before you're 66. Might only be about $10 a month, but you're getting 5 extra checks as long as you're not earning more than that $45,000 in those 5 months. So there's some options that you can look at. There's a lot of publications on our website, talks about how work affects your benefits that you can look up. Any questions on this? Because I know it can be confusing. Yes? Okay, good question. So she wanted to know if her earnings affect her spouse's ability to collect. No. Everyone is taken individual with Social Security. Your earnings account for your ability to collect Social Security benefits and your husband's for his. And Social Security only counts earned wages. So they don't count any kind of investments or 401ks, anything else, that you might have, rental income, only wages, work that is FICA taxable. Yes? Yeah, and I'm going to get to that too. Yeah, I do have a screen on that because it's so popular. So just to confuse things, full retirement age has changed from 6 to 66 through 67, but Medicare is still, you're eligible for Medicare at 65. You also can be eligible for Medicare after you've been on Social Security disability for 24 months. There's a waiting period of 24 months. Same Medicare that you would get at 65. You can also get Medicare if you've been diagnosed with ALS or if you have kidney failure without a waiting period, regardless of whether or not you're working, you can still get Medicare coverage. So that's basic 4 ways that you can get Medicare. Medicare has 4 parts, A, B, C, and D. A and B you file for at Social Security. C and D you would file for with a healthcare provider. Part A is the hospital insurance, premium free for anybody who has their 40 credits. Part B is the medical insurance. Right now, it covers 80% of a reasonable charge after a calendar deductible. I believe it's $186. $183. $183 is the annual deductible. Part C is the Medicare Advantage plan, kind of like an HMO, and I'm sure he'll go over that. Johnny will go over that with you. And Part D is our newest plan. That's our prescription drug plan. Enrollment can be tricky, especially now because we have Medicare is still available at 65, and yet the full retirement age is 66. So the question rises, what do I do at 65? Do I take Medicare? Do I not take Medicare? So it's really an individual thing. You have to look at whether or not you're working and covered under a group health insurance plan, either based on your employment or a spouse's employment. So Medicare has 3 enrollment periods. Your initial enrollment period is 3 months before you turn 65 through 3 months after. If you choose not to take Medicare at 65 because you're working and covered under that plan at work, you could qualify for a special enrollment period. So the special enrollment period is for anybody who's over the age of 65, past their initial enrollment period, maybe turning 66 and deciding to do everything at that age. You can have a special enrollment period, and you can get Part B whenever you need it. You're retiring from work, and you're dropping your plan, your coverage at work. You can get Medicare the month after your coverage at work ends. So that's a special enrollment period. If you miss your initial enrollment period, and you don't qualify for a special enrollment period, the only other time you can get Medicare is during the general enrollment period. It's January, February, March of every year. It's not effective in July. The problem with the general enrollment period is you might be penalized if you didn't take Medicare at 65 and you didn't have what was considered to be credible coverage, which is covered under a group health insurance plan at your work or your spouse's work. Anybody who, so for an example, I'm 65, I'm not working, I retired, I've been collecting benefits at 62. I turn 65, they automatically offer me Part B. I get the card in the mail, and I said, I'm not paying $134. I'm healthy, I don't take any prescriptions, and I don't go to the doctor. So you decide that you don't want to take Part B of Medicare at 65. Things are going all along very well. You don't have any other health insurance. You have the Part A, that's the hospital insurance, and you seem to be happy with that. Starting at 68 or 69, now you start to have a little bit of health problems. Now you're seeing you have to go to the doctor. Maybe I should have taken Medicare. So you go in, it's January, and you say, I want to enroll in Part B of Medicare. You're 68 years old. Now you can't get Medicare until July because now you're in the general enrollment period. And you could potentially pay a 30% surcharge because you're 68, 3 years that you haven't had coverage. So they're going to penalize you a 10% surcharge for every 12-month period that you didn't have Medicare that you could have for that every 12 months. The premium is 30% higher, but you did save yourself 3 years of premiums. So you kind of have to balance that off and decide what you're going to do. So it's an important decision to make at 65. The only time I would caution you not to take Medicare at 65 if you were still working is if you're covered under an HSA, a healthcare spending account. If you actively contribute to an HSA through a bank, or I don't know if you do have them. So if you have one of those high deductible health insurances and you have HSAs, do not take Medicare because it will disqualify you and you could be penalized for doing that. It's not a Social Security rule, it's an IRS rule. So just cautionary word out there. At 65, some people say, you know what, I'm not going to retire, but why shouldn't I take Medicare? It's free health insurance for the hospital. Just cautionary word. If you do have the HSA, do not file for that.
And also, just HSA is different than the FSA.
Right. And an HSA is different than an FSA, a flexible spending account. Flexible spending account is through your employer. You can have Medicare with an FSA, just not with an HSA. So it's just make sure that you know what you're contributing to. And you can still have an HSA. You just can't actively contribute to it. So you can leave it there and then use it. You can actually use it to pay your Medicare premiums and to spend it on your health care costs. But you just can't actively contribute it for up to 6 months before you have the Medicare. So you have to stop, okay? You know all about that though, right? Okay. This year, the standard premium for Part B is $134 a month. That's about 25% of the actual cost of Medicare. So the government subsidizes the other 75%. Part of the 1983 amendments also was if you have more of income, you can afford to pay more of that 25%, then the government will ask you to do that. Right now, if you file jointly, if you have adjusted gross income of greater than $170,000 jointly, $85,000 for a single filer, you will probably pay higher for your Medicare. They look at your income from 2 years prior to when you enroll in Part B. So if you're going to take Part B at 65, 2 years before that tax year when you were 63 is an important year for the Part B. So if you were going to sell something, okay, if you had to cash something in, just be cognizant of the year that you do that, because 2 years later, when you're enrolling in Medicare, it could affect the amount of the Part B premium that you pay. There are some exclusions to this if you retire at 65 and you sold a piece of property at 63, or if you cash something in. Retiring is a life-changing event. So they can say, you can ask them to look at a different tax year. You can say, wait a minute, you know, I retired, so I don't want you to look at my income before I retired. I want you to look at my income now, and we can do that. But just be aware that if this applies to you, they'll send you a letter saying that your Part B premium is higher, and that if you want to do something, if you think you have a life-changing event, and that being a change in employment, a change in marital status as well. There are some other ones. On our website, you can look that up. But just to be aware, and it only lasts 12 months because that tax return that we look at is a rolling one. So at 66, we're going to look at your tax return from 64. If your income has dropped down, then you might only have to pay the 134 or whatever the premium is. All right, questions on that? Okay. Who else can get benefits on your record besides you? As I said, we're going to ask if you were ever married. So, a woman or a man who's never worked outside the home is eligible for up to 50% of the worker's benefit when the worker files. So if I file for my retirement benefits at 66, my spouse, who is either not eligible for a benefit or is eligible for a very small Social Security benefit, can collect up to 50% of mine. Does not reduce anything I get. So if my benefit is $1,500 a month, I'll get $1,500. He gets $750, each independent of the other. An ex-spouse can do the same thing. If you were married to somebody for at least 10 years, you're finally divorced, the spouse that you want to collect benefits on, so if that's me, I want to collect on my ex-spouse's benefit, I have to be unmarried, and my ex-spouse has to be at least age 62. He doesn't have to have filed the claim, but he has to be eligible for it. And I can file on his record if I was 62 up to my full retirement age and collect a benefit on his record. Does not reduce anything that he gets or any spouse that he might have on the record. But we have to have been married 10 years, and I can't be remarried. He can be remarried, but in order for me to collect on his record, I can't not. If he passes away, we were married for 10 years. I'm 62 years old. At 61, I did remarry. I can be remarried on a surviving divorced spouse's benefit. If I was married after the age of 60, I think there was a congressman's mother who was living in sin, and he wasn't happy about that. So that rule changed. Because if you used to get married, you used to become ineligible for the benefit. Yes? So anytime anytime you collect a benefit from Social Security under your full retirement age, there's an earnings limitation. So if you're between the ages of 62 and your full retirement age, there's an earnings limitation. You can't be working and want to collect on your ex-spouse while you're waiting to build up your own. That $17,040, that limitation does apply. If you're a widow, which I'll get to in a minute, but widows can collect as early as age 60. Widows are the ones who have the option of collecting one benefit and then switching over and collecting another. divorced widows can do that as well. So at 60 years old, if you just wanted to retire from your job, but you wanted to still build up your own, you could actually retire at age 60, start to collect either widow's benefits or divorced widow's benefits, and build up your own until whatever age you decided you wanted to collect your own benefit at and switch over. So at 60, you can collect till 70 or maybe just till 66 and get 100% of yours. You'd have to crunch the numbers and just see which is more beneficial. Some people like to take the lower benefit first while they're able to work part-time and supplement it, and then build up the other one for when maybe they're older and they don't think that they'll be able to work and supplement their income. But it's up to you. Maybe you can't afford to live on the lower one first and then switch over. But widows do have that options, whereas wives don't really have an option of taking one and switching over to the other. Yes?
Yeah, if I defer my Social Security and I'm eligible for, say, another 8%, is my wife get 50% of that as well? Or even if she's not, say, since she turned 65 or 66,
Yeah, so the question is, can I file for my benefit but defer it and not collect it to build up the 8% or 32% till 70? If I do that, can my spouse collect benefits on my record? So that's a file and suspend question. I don't know if you've heard about the file and suspend. So it used to be that if you were your full retirement age,
yeah, I'm not sure that's, I just mean if I were to defer mine for a year, say I turned 60,
right,
so I get an extra 8%. My wife at that time turned 66.
right.
Okay, so is she eligible for
Yeah, that is.
that plus the 8%?
Oh, so is she eligible for because you deferred it? Gotcha. Okay. Yes. Okay. So the question is, not the file and suspend. The question is, if I defer my retirement and get an extra 8%, when my wife files, does she get 50% of my 108? No. You collect the deferment higher amount because you did defer your benefit for 12 months. Your spouse doesn't get credit for that until you pass away. Then they call them, so watch the oatmeal. Delayed retirement credits is what we call that. So you delayed your retirement to get those extra credits. Those are not payable in life to anyone but the worker. Once you pass away, if you were at 108% or 116%, then your wife is eligible for widow's benefits. She would get the 108 or the 116. But she would only be eligible for up to 50% of your full retirement age benefit, 100%. That's okay. So I'll answer my own question that I thought it was, the file and suspend question, because that comes up a lot. So file and suspend used to be a filing strategy that some financial planners had come up with, or they discovered. And basically it said, if I'm my full retirement age and I have a spouse who's my full retirement age, we can both file. The higher wage earner would file and suspend, which would allow the spouse to collect 50% of the worker's benefit. So the Bipartisan Budget Act of 2015 determined that to be an unintended loophole, and it closed it. So anybody born 1/2/54 or later cannot do that. If you were born before 1/2 or 54, you still can do it if your spouse is collecting the benefit. You can collect at your full retirement age 50% of your spouse's benefit and build up your own till 70. Anybody born 1/2/54 or later doesn't have any options at all. Any questions on that? Okay. Any more questions on the divorced spouses? And I'll give this example because it makes people laugh. So if I found 3 men that I wanted to be married to for 10 years and divorced, each one of them could collect 50% of my benefit if their benefit was less than 50% of mine, which it was, which is why I divorced them. So husband A, we was married to for 10 years. He never worked. I turned 62. He can collect 50%. Husband B, we were married to for 10 years. He's not eligible for more than 50% of my benefit. He also can collect when I turn 62. And so can my current husband can collect as well. and then I give up. But I collect 100% of my benefit, and each one of them collects 50% without reduction. No one gets a reduction. I don't get a reduction, and husband A, B, or C doesn't get less. They don't have to share the pot, is basically what I'm saying. All right, so that's how that works. So another strain on the trust funds with everybody getting all these marriages and everything. Okay, so children can also collect benefits. Most of the time, by the time you reach retirement age, there are no minor children, but it could be if you adopted, or it's miracles of science. But if more than often than not, you might have a disabled child who was disabled before the age of 22, who is currently unmarried and not working in a substantial capacity, regardless of that child's age. So the child could be 40 and be totally disabled since before age of 22. They could collect on your record when you retire. A child of a life claim, so a retiree or a disabled worker, that child would get 50% of your benefit. If you should pass away, that percentage goes up to 75%. A widow can collect up to 100%. Children can collect up to 75%. Questions on that? I like to mention Social Security disability benefits at a retirement seminar because many people don't realize that you can collect Social Security retirement and disability, file for that at the same time. A lot of times people might retire early at 62 because they just don't feel healthy enough to continue to work. So they file early. What's the percentage you get at 62 if your full retirement age is 66? 75%, right? If you file at 62 for retirement and they ask you, because they will ask you on the application if you file online or in person if you file in the office, they will ask you, are you totally disabled? If you say yes, we'll take a disability claim from you. If you get approved, we're going to bump you up from 75% to 100%. So that's the reason why you would want to file for disability before you reach your full retirement age. Once you reach your full retirement age, there's no more disability because the percentage, there's no benefit for filing after your full retirement age. You're only going to get up to 100%. But if you file early and you're totally disabled, or you file at 62 and God forbid something happens, you get a catastrophic illness at 63 or 64, contact Social Security, file for disability, and they'll bump up the percentage that you get. No one plans to become disabled. And even for people, for your children or, your grandchildren, people don't realize that Social Security is a protection for them. It's a safety net. It's like an AFLAC plan that you pay into that you don't really realize. Social Security disability is there for you. If you're paying into Social Security taxes, those FICA taxes, there's a protection for you for disability, and it helps a lot of people. Our Social Security definition of disability is not like some private industries or other government agencies. You have to have a current connection, so you need 5 years of work in a 10-year period for most people. The disability has to be expected to last at least 12 months or end in your death. So it's not like a TDI that Rhode Island has. It's a long-term permanent disability that Social Security has. Everyone's favorite topic is taxes. We just passed tax year. The government gave us a couple extra days to get those taxes in. A lot of people want to know if Social Security is taxable. It's not 100% taxable, but many people, about 85% of the people who get Social Security benefits do pay taxes on that. If your adjusted gross income is greater than $25,000, if you file jointly, file single, $34,000. If you file jointly, a portion of your Social Security would be taxable. We send you a 1099 at the end of the year, at the beginning of the following year. Tells you how much you would take that to your tax professional to determine whether or not your Social Security is taxable based on your income. If you want to have voluntary taxes taken out, you can complete the form W-4V, like voluntary, send that into Social Security. We'll take those taxes out for you and send those to Uncle Sam. That is a one-way train, though, so we can start and stop it at any time, but we can never get those taxes back from you. You would have to file your tax return for that. That concludes my presentation. Not bad. I hope that you've found the information that I gave you to be helpful in your retirement, and that if someone asks you about Social Security, whether or not it will be there for them in the future or why it's important, you can use the information that you learned today to answer them. And I will take any questions that you have. Yes?
Yeah, so you mentioned that the Social Security increases by 8% per year after 66. Is that counted on monthly? So if you were 66 and a half, would you be at 4% more?
Right, so the question is the 8% increase that you get for delaying your retirement past your full retirement age, for example, 66. If you went out at 66 and a half, would you get half, like 4%? Yes. So it's incrementally every month that you delay your retirement past your full retirement age, you do build it up. So if you were 66 and a half, you'd get an extra 4%. Yes. Yes.
I don't have a question, I have a compliment.
Oh.
Every time I get contact Social Security by phone or in person, they have been extraordinary.
Thank you. Thank you. That's nice to hear. I appreciate that. Yes.
Who decides the retirement age?
What is the what?
Who decides?
Who decides the retirement age?
Yeah. 66?
The chart. Well, we have a chart, right?
Yeah.
Based on your year of birth, and that's Congress determines.
I mean, so
It's based on your year of birth.
you're not talking about mandatory retirement age.
No. When you
You are retired.
you can choose to retire from your job and not take Social Security. When you take Social Security, is totally up to you. The percentage that you're going to get is based on your year of birth. So if you want to retire from your job at 62 years old, but you don't want to collect Social Security because you want 100%, that's perfectly up to you. No one from Social Security comes knocking on your door or automatically enrolls you in anything. We hear that sometimes, you automatically enroll me in Medicare at 65. No, no one automatically enrolls anyone in anything from Social Security. It's totally up to you. So for me, if I decide to retire at 62, I probably will wait to collect my Social Security till 62, though I'm not going to, I'll leave my job. But leaving your job and filing for Social Security are two totally different things. Yeah.
So basically, he or she decides himself or herself when
Exactly. Yep, you make that decision yourself, which is why you come to these seminars and you talk to Pat and you ask those questions to make the informed decision as to your whole package. When can you afford to actually stop working and do all that?
in some countries they have mandatory retirement
Yes. Yep.
age, but not here.
Correct. Not yet. How about I'll say that? Some jobs do as well. You're right. Yes.
With the Medicare Part B premium, if your income, you have to pay a premium. So when you're getting ready to retire, your last 2 years of income, working full time, you're probably at your highest level of income. So that's what they look at when they're determining your premium. You said something about you can ask them to look for a federal funding.
Yep. Right. So when we're calculating your Medicare premium, you're right. That's if you're retiring right before you want to file for Medicare, we will look at probably what's going to be a high year for you. You can ask for you can say, I have a life-changing event, I've retired. Can you look at my tax return from this year? And they will. If it will drop it below. Yeah. Yes.
You were talking in the beginning about how Congress may shore things up by making some changes. And so I was wondering if the kinds of changes they might make could kind of interfere with just long-term planning. So say I decide I'm going to wait till 70 and get that 132%, and that's a lot of money I'll have, and then I'll do this, and then I'll do this. But meanwhile, Congress decides to fix things
Yeah, I mean, that's total speculation, and your guess is as good as mine as what Congress will do. The 1983 amendments really didn't start affecting people till 20 to 30 years after the full retirement age changed. They did that in '83. The people who it affected really were filing for retirement for 20 or 30 years down the road. So it's, your guess is as good as mine. You know, there's a lot of talk out there what they're going to do. One of the things right now is you pay Social Security FICA taxes based on a maximum of $127,000 right now. So that's another thing they're talking about, is increasing the amount of FICA tax that are paid, increasing that ceiling right now. So we'll see. Stay tuned. Hopefully it will be good, and hopefully they'll act soon. You know, you say 2034 sounded like so long ago, right? But it's actually not really that much into the future when you think about it. So hopefully they will act and do some good stuff soon. But certainly, you know, contact your congressman. There's right here in the state of Rhode Island, and I know in Connecticut, they are very active with ideas for that. Okay, I do appreciate your attention. I hope you learned something from me today, and I will be around for a while to answer any private questions. Thank you.
Okay, hello everyone. Okay, so I'm going to talk to you about the series of health plans that you would go through at retirement. And I will explain each one of these in detail. So we're going to start off, you first retire, you're eligible for COBRA if you're under 65 for the medical part. But I will explain this in a minute. So first is COBRA, which is the extension of your active benefit. The medical includes the prescription just like you have it now. Dental and vision is the same, and this coverage can last for up to 18 months. If you're not yet 65 when your 18 months of COBRA is exhausted, then you go to what's called the early retiree plan, which we have two, the early retiree and the value plan. Same medical with prescription, no dental and vision, and coverage lasts to age 65 or Medicare eligibility. And then you become eligible for Medicare, so we have some Medicare plans that go along with your federal Medicare. So for COBRA, it's the same medical, dental, and vision benefit as if you were an active employee. You retire one day, your COBRA becomes effective the next day. The same co-pays for prescriptions. The medical benefit, however, is only eligible for people who are not yet 65, but the dental and vision are still, if you're over 65, you can still take the dental and vision. Your spouse or partner is also eligible for COBRA if they're on your family plan. And the price of COBRA also includes a 2% administration fee. These are the monthly rates for COBRA. The medical plan is based on an individual plan for the state now, the dental plan and the vision plan. For the dental and the vision, for someone who's over 65 but still wants to continue their COBRA, it's the least expensive way to take this benefit. So I always tell everyone to exhaust your 18 months of COBRA for dental and vision first, because you're not going to find a dental plan out there for $31 a month, especially for the benefits that we have right now. So if someone wants to continue with dental and vision, this is the least expensive way to do it after retirement for the 18 months. If you're not yet 65 or your spouse is not yet 65 when your 18 months of COBRA is over, then we have the early retiree plan. It's the same health insurance plan that we have now. There is still the $250 deductible for an individual plan. There is no dental or vision coverage. Prescriptions are the same, $725 and $45, but the current cost is $1,117 a month. There's what's called the early retiree value plan. So it is, again, the health coverage between the end of your COBRA and your age 65. It has less medical coverage, but it's at a reduced cost. So you can see at the bottom, instead of $1,100 a month, it's the $700, which is equal to the COBRA price. But the difference here is there's a $2,000 deductible as opposed to a $250 deductible on the early retiree regular plan. Does not include dental and vision, and the prescription drug price is a bit higher. But if you have someone on your plan, a spouse that is under 65 or you're under 65, if you looked at the Rhode Island Health Source Exchange for the price of plans, this is probably equal to that. With Rhode Island Health Source, the price might be a little bit lower, but the deductibles are a lot higher. So at that point, we will sit down and look at the kind of health insurance you might need until you're 65. Becomes a math problem after that. It's not cheap. Any questions on pre-65 medical after retirement? Yes?
If your spouse is working at another job,
Mm-hmm.
has insurance at that job, not on the plan here, but is under 65, will they be covered in this plan?
If they want to, but their work health insurance might be less expensive.
Well, I'm saying if they want to retire,
Oh yeah, sure. They're eligible because they're your spouse.
okay, even if they're not on,
Yes, that's correct. If they're on your family health insurance now,
no, I'm saying they're not. They have,
they could still be covered under the spousal plan. It's not a problem. The price is the only problem, because it is not cheap. All right, so now we talk about Medicare, but I'm actually going to defer the Medicare to Dr. Liu, because you've heard it from Social Security, and he has a much better presentation than this here. So we're going to skip ahead a little bit to the SRP time. So anyone have what's called Bruce Sunland time? This is what, yeah. So this is the time in 90 and 91 where you had to work for 10 days, but you got paid for 9, and that one additional day was banked for you. And Bruce Sunland was the governor, so they call it Bruce Sunland time. But it's really called salary reduction time, SRP time. So it's based, the way you get paid out is based on your salary at retirement, but it's divided by 244, which is the average number of days worked by the faculty, then multiplied by the number of days in the bank. The most you would have is 203 hours or 29 days. It lasted 29 pay periods. So you may not have the full 29 days. You may have used it during a sabbatical. You were offered the opportunity to get paid out for it as soon as this time ended, but a lot of people left the money in there, and it is a nice check at the end of retirement. So that would still be paid out to you. It is paid out 2 pay periods after your final paycheck. And it does not go direct deposit, it is mailed to you. And 25% is withheld in federal taxes. They automatically do 25% whenever you get a payout check. Any SRP questions? The other benefit that you can continue besides health insurance is your life insurance. So if you have life insurance now with the state that you're paying into Aetna, you can continue that in retirement. You can, right now you can have basic and supplemental health insurance. Only the basic can be continued in retirement. And the value of that is based on the salary at age 65. In our payroll forms, there is a field there that's frozen for age 65 in salary. So we know what the frozen valuation is. And then the insurance is reduced at these percentages until it becomes 25% of their age 65 salary, and it never reduces after 25%. I bill you for that on an annual basis. So every year in December, if you decide to continue your life insurance, you'll get a yearly bill from me in December. And because I'm leaving a lot of the Medicare info to Dr. Liu, that's pretty much it for me, unless anyone has any other questions at all. Yes?
Phase out retirement, I assume that after 2 years, you're officially retired as of July 1st, the academic year?
Yeah, the question is about phased out. It goes to the end of the academic year, so this year it's June 23rd. Because it's never well, it could be the first of the month, but because we have 26 pay periods, it's kind of an odd day. The last pay period. And when you're unphased, if anyone is going unphased, your health insurance remains the same. Obviously, your salary is cut in half. The price that you pay for those benefits, your benefits stay the same, your medical, dental, and vision. The amount that you pay for that is cut in half because it goes by salary. And your insurance, your life insurance, if you have it, that's also cut in half. So you can't keep the higher level of life insurance. That goes in half as well. Now, when you're on phased retirement, in the TIAA world, it is also considered retirement. So if you're on phased retirement, you can start to collect on your mandatory retirement account even though you're still working. It's one of the benefits of phased retirement. It's considered retirement for withdrawal purposes. So if you wanted to start to withdraw from your mandatory account, we can put a term date on your file, and that way you have full access to your retirement money, not just the supplemental account. Because right now, while you're still working, you can't withdraw from the 5 of your mandatory 5 or the university's 9, but in phased retirement, you can. Yes?
Is phased retirement still in effect, or is that?
It is. You apply for that through the provost's office. And it's a 2-year program. It used to be 3. But as far as I know, it is. I think the deadline for next year is passed, but you could probably talk to the provost's office if you were really interested.
Oh, okay, I thought it was totally.
No, we have people going on next year. Yeah. Any other questions? Okay, then I would like to introduce, did you have a question?
Just one more, how far in advance for retirement, if we do regular retirement, how far in advance do you need to see?
I only need to see you about 2 months in advance in order to apply for the Medicare Part B. So that kind of process takes about a 6-week time period, so 2 months is enough. Thank you. So I would like to introduce Dr. John Liu from Doctor's Choice, who is all knowledgeable in Medicare.
Thanks, Pat. Let's see if I'm all knowledgeable in PowerPoint. Oh, there it is. Perfect. Great, thank you. All right. Hey, everybody, I'm Dr. John Liu. Just call me John. So today I'm going to give you a quick crash course to Medicare. I know Catherine already gave us a pretty good overview of the various parts. So this presentation only takes about 20 or so minutes. I know that most of us can't take more than 15 minutes of Medicare, so we'll wait till the end to explain what we do and our story and so forth. So I'm just going to dive right in. So the goal of today is we're going to go through the quick ABCDs of Medicare, give you a crash course, and then also if you're thinking about retirement, congratulations. If you are, I'm not going to ask you to raise your hand because we've had situations where people gave away their retirement dates, and we don't want you to do that. And then also we're going to go through your big choices. Here in Rhode Island, also touch base a little bit more, expand on what Pat was mentioning about if you are fortunate enough to marry young, what to do under 65. So what is Medicare? So Medicare is all these different letters that'll drive you nuts, the alphabet soup, the ABCDs. So Part A covers you in the hospital. That's you staying overnight in a hospital bed. And Part B covers you for outpatient. That's going to the doctors, imaging, outpatient surgeries where you're in and out the same day. And it doesn't cover you for prescriptions either. And then also there's the other parts. So again, Medicare, to qualify for Medicare, you've got to be age 65 or older, and or disabled for 24 months. It doesn't matter how old you are. And then, so again, here it is. The Part A covers you in the hospital. Part B covers you for outpatient. And for Part A, you don't get, there's no monthly premium because you paid into the Medicare system when you were working. But for Part B, there is a monthly premium. That monthly premium is $134 per person per month. So if you're a couple, double that for 2018. And then also, as Catherine had mentioned, if you make more than $170,000 filing as a couple or $85,000 filing single, then you will pay more for your Part B based on your income. But unfortunately, you don't get much more for that. So Medicare Parts A and B, they don't cover everything. These are the big AARP commercials that you hear every time you go to the gym. And this is what they're talking about. So with Medicare Part A, every time you go into the hospital, you're on the hook for a $1,300 deductible. That's per hospital stay typically. And it's $1,340 for 2018. So you could potentially pay multiple deductibles throughout the year. And don't worry, we'll talk about how to deal with that. And then there's Part B, which is there's a small deductible. It's $183 per year. Now, once you meet that $183 deductible, then you're on the hook for 20% of the cost. Now, 20% for doctor's visits are not a huge deal, but for things like outpatient surgery, for chemotherapy, and so forth, that does tend to be very expensive. Chemo can cost upwards of $100,000 a month, so 20% of that can be pretty hefty. And with Parts A and B, there's no limit on how much you can spend. So if you did have that $1 million outpatient procedure, you would be on the hook for 20% of that. So let's talk about how to deal with it. So a lot of people, what they do is that they pick up a supplemental plan, and these are the Medigap plans, or the true supplemental plans that I'm talking about. So just to make things simple, there are plans A through N, and each plan covers you a little bit differently in terms of the level of coverage. But we're going to simplify this a little bit for you as well. So with the supplemental plans, these are what I call the Cadillac plans, because these plans allow you to go to any doctor, any hospital that takes Medicare in the entire country with no referrals. These plans also have minimal or very low or sometimes no out-of-pocket expenses when you do use the doctors, so they can be very robust. These plans require no referrals, so you don't have to go get a referral from your primary care to see a specialist. But these plans also do not cover you for prescriptions, so you have to get a separate Part D plan with that. And we'll just go through some examples of how these supplemental plans work so it becomes more concrete. So Medicare Part D, D for drugs, again, that's where the simplicity sort of stops. With Medicare Part D, covers you for prescriptions. And then, so in Rhode Island, for example, there's over 21 different plans to choose from. And the right plan for you is solely dependent on what drugs you take and what pharmacy you prefer to go to. And their copays based on tiers, so similar to your plan of URI, where generics are less expensive, brand name drugs are more expensive. It's also something called a donut hole. Has anybody heard about the donut hole? Or, okay, so most of you have. So I'm going to try to explain the donut hole in about 30 seconds. So the key takeaway from the donut hole is that unfortunately this is where Medicare does fall a little bit short, where if you have really high drug costs, meaning if you have high brand name medication costs, insulins, inhalers, specialty tier medications, if you have multiple sclerosis, things like that, you will have to pay ultimately more out of your pocket for drugs than you are typically used to. That's the key takeaway. But essentially, so Medicare only covers you for about $3,700 worth of drugs. That's the full retail cost. So let's say you had a $300 insulin and your copay was $30. That full $300 gets counted towards the $3,750. Once your total drug cost reaches that amount, you're in the donut hole. And in the donut hole, you're paying roughly a third of the cost of your prescription. So that $300 drug now becomes a $100 copay instead of the $30 you were paying before. And this goes on until your drug costs out of pocket reaches about $5,000 out of your own pocket, in which case you fall into catastrophic, where you pick up 5%, Medicare pays the 95%. This calculation resets every single year. So January 1st, this calculation resets and you start at zero again to start racking up the $3,750. They're looking to close the donut hole by 2020, in which case hopefully our cost sharing in the donut hole will be somewhere around 20-25%. So let's talk about Medicare Advantage plans, which is Part C. So the key takeaway from this presentation is that there's really only one big decision you have to make with Medicare. It's not the A's and B's. You just have to sign up for it. And Pat does a wonderful job of helping you through that process. And our office can do it as well. But the big decision is whether you want to go for a supplemental plan or one of these Medicare Advantage plans. So Medicare Advantage plans also are called Part C plans. So you might be wondering, we're talking about A, B, and D. Where does Part C go? So Part C is its own standalone option. So think of it as its own animal on its own. So Medicare Advantage plans, they're administered by private insurance companies like a Blue Cross or United. You still have to sign up for Medicare Part A, your hospital, B, outpatient, and then you sign up for Part C, which oftentimes will include your Part D drug plan. So it's an all-in-one plan, similar, again, to a plan that you have from work. You can have copays. So the benefit of having one of these plans is that typically it's a lower monthly cost than a supplemental plan. So lower cost, but the trade-off is that there's more restrictions. So typically these plans will have networks. So you have to stay within a certain network. You may have to get referrals from your primary care doctor to go see a specialist. And then also you can have copays, out-of-pocket expenses for when you do use medical services, and we'll go over what that looks like a little bit as well. So that's your one big decision is whether you're going to be on the Medicare supplemental route or the Medigap route, or you're going to be on the Medicare Advantage route. So let's take a look at who signs up for a Medicare supplemental plan. And a typical profile of someone that signs up for a supplemental plan, they're either unhealthy, where you're in and out of the hospital, you've got outpatient procedures you've got coming up, you're managing chronic conditions, so you need a lot of medical services. It makes more sense typically for you to pay more upfront in order to save more money as you go. Or it's somebody, snowbirds, if you're thinking about staying 4, 5, 6 months in Florida, Arizona, South Carolina, California in some cases, and if you like higher taxes, and you want that flexibility of being able to go anywhere you want. So you don't have to worry about having a primary care in California. When you go, just go to whoever takes Medicare. Or somebody that says, well, I'm healthy today, I don't know what's going to happen tomorrow. I want to be protected just in case. Because in Rhode Island, not in Massachusetts or Connecticut, interestingly, in Rhode Island, if you don't get on a Medicare supplemental plan when you leave work, it can be very difficult for you to go on a supplemental plan that's very robust down the road. If you choose a Medicare Advantage plan and you want to switch up, it can be hard to do so in Rhode Island. Typically, the companies will require you to go through medical underwriting similar to life insurance, and if you're unhealthy, they won't take you. But if you're unhealthy and you go on it when you first start Medicare after leaving work, no company can deny you coverage for any reason. As long as you keep on paying your bills, you will not be dropped if you have really high expenses. And then, so let's take a look at what happens when somebody joins a Medicare supplemental plan. So this is Dr. Smith. He's 67 years old. He's got a past medical history. He's got a triple bypass, of heart conditions. He's got diabetes. He's got a knee replacement coming up. So he's going to be somebody that we're going to recommend to go for the Medicare supplemental plan. This is what his options are going to look like. He's going to pick up Medicare Parts A and B. And one of the more common supplemental plans that we see is called Plan G. So with Plan G, there's a very small deductible, but then after you meet that $183 deductible, it's covered 100%. Meaning after that, you're paying no doctor copays, nothing when you go to the hospital. As long as it's a Medicare cover service, you're not paying anything and go anywhere. So it's the Cadillac plan. So in his situation, and he's also got to pick up a Part D drug plan, which is extra. So monthly cost-wise, so nothing for Part A, $134 for Part B. Average cost for Plan G at age 67 in Rhode Island, you're looking at about $120 a month. And that does go higher, unfortunately, the older you get. And then about $30 for a drug plan. So you're looking at close to about $300 all-inclusive for that option if you want to go for the higher route. So what happens when Dr. Smith decides to go to the doctor? Primary care, as long as he meets his deductible, doesn't pay anything. Specialist, nothing. Outpatient surgery, nothing. Hospital, nothing. So he doesn't have to worry about big expenses. If he has that knee surgery, he goes in the hospital for 3 days, gets out, does PT, goes to rehab for 20 days. It's going to cost him nothing. And he gets the freedom to go anywhere in the country that takes Medicare. So if he wants to go to Boston, he can do it there. If he wants to go somewhere else, he can certainly do it there. The only copays that he has to pay for are for his prescriptions. Unfortunately, there's no way out of the donut hole for most people. Now let's see who signs up for a Medicare Advantage plan. These are folks that are saying, I'm really healthy and I don't travel much, or I don't like to cross bridges in Rhode Island, and I'm okay with saving more money up front on a monthly basis and putting that difference in the bank if I have a rainy day, or spend the money. Or unfortunately, somebody with very limited income, they might only be able to afford $150 or so a month for their medical. And for all of the out-of-pocket expenses, they're going to have to work out some type of a payment plan with the provider if something big does happen. Take a look at an example. Mrs. Jones, she's healthy. She's going to sign up for a Medicare Advantage plan. So the secret with the Medicare Advantage plan is that unlike the supplemental plans, it's one price for all, meaning that it doesn't matter how old you are, that's one price. So Part A, again, $0. Part B, you got to sign up for it. You still have to pay that $134 for Part B. Everybody has to. Average price for Medicare Advantage plan in Rhode Island, you're looking at somewhere between $20 to $30 on average. So you're looking at about $150 for an all-inclusive plan that includes drug coverage. Some of these plans may offer you additional benefits as well, such as they might throw in vision, they might throw in a little bit of dental, they might throw in a gym membership or so forth. So these are the types of plans that we hear all the time when people say, well, my friend has this plan that they get to go to the YMCA for nothing, or they have silver sneakers. They're talking about a Medicare Advantage plan. So let's see what happens when Mrs. Jones needs care. So these are the way that these plans are all structured, and I wanted to highlight some of the biggest expenses that you can incur when it comes to Medicare Advantage plans. So again, monthly price, you're looking at saving about $150 a month, close to $2,000 a year versus a supplemental plan. However, what happens when you do need care is that you're gonna have to pay for it. Hospital stays, usually how these plans work is that they will charge you a per day hospital stay. So every day that you stay in the hospital, in this case, it's $350 per day, up to 5 days, meaning if you stay for 5 days, you're somewhere around $1,800. If you stay for more than 5 days, you're covered 100%. And then primary care, in this case, $10 copay. You're going to have to get a referral to go see a specialist, which is going to be a $50 copay. Outpatient surgery. So hospital and outpatient surgery is where things can get really expensive for the Medicare Advantage plans, because the outpatient surgeries, you're looking at typically these plans will charge you about 20% of the cost. Meaning if you had cataracts, for example, one of the most common surgeries, about $5,000, you're looking at paying about $1,000 out of your own pocket. And then also, you're still going to have co-pays for your prescriptions. They're going to be tiered, usually 5 tiers. Generics are tiers 1 and 2. Brand name drugs are tiers 3, 4, and 5. Again, big decision. Supplemental plans, Cadillac plan, higher monthly premium, low or no out-of-pocket expenses, go anywhere. It's the prepaid plan or the Part C Medicare Advantage plan, sort of the pay-as-you-go. Lower monthly premiums, some extra benefits, but limitations on network, and you're going to have co-pays and out-of-pocket expenses. Medicare does not cover you for a couple of major things. One is dental, the other one's vision. Spouses, meaning that if you've got a spouse that's under 65, unfortunately Medicare will not cover them. But if both of you are over 65, you can actually choose 2 separate plans. You don't have to be on the same plan. And then also doesn't cover you for, unfortunately, custodial care or home care or long-term care. So Medicare covers you for 100 days in a nursing home. Once you go past that 100-day mark, then you're on your own. That's where long-term care insurance, Medicaid, or self-pay comes in. So let's talk about when and how to sign up. I know that Catherine went through the enrollment periods, but I'm just going to dive down a little bit more into what's really applicable in your situation as somebody that's working at URI. So a lot of people that are working at URI, they will retire after 65. And when you do retire after 65, the takeaway is about 2 to 3 months before you decide to leave work, talk to Pat, and she'll walk you through the timelines and so forth. And our recommendation is simply 2 to 3 months before you retire, get the ball rolling in terms of the paperwork. And with Medicare Part, so if you don't have an HSA, or health savings account, then we typically recommend that you sign up for Part A even if you are working. You can sign up 3 months before. You can do so really easily online, ssa.gov/Medicare. Go down to sign up for just Medicare and sign up for just Part A. Gives you a little extra coverage, for hospitals, but it doesn't cost you anything on a monthly basis, and you're not really losing anything. And if you do opt for the HSA option, so how you can tell if it's an HSA is that if it rolls over year after year, and you get to keep it even after you leave work. So if you do sign up for an HSA plan, then just don't do anything, and you will not be signed up for Part A. And our recommendation is that same thing, 3 months before you retire, you got to sign up for Part A. And what will happen is that you will have to stop contributing 6 months before you leave work, because there's a 6-month look-back period for Part A, meaning that let's say if you decided to retire, for an effective date of July 1st, then our recommendation is typically you stop contributing December 31st of the previous year, because anything that's contributed from January 1st to June 30th will be subject to taxes because it's a 6-month look back for Part A. And then signing up for Part B, and don't worry if this is, I know it's really, really confusing, so happy to answer any questions on an individual level. But typically the key takeaway from this presentation is that this slide here is that 3 months before, start the process. And as long as you're covered by URI's plan, you will not face a penalty. Doesn't matter when you sign up. So you can sign up at age 70, 80, 100, 200, no penalties. And then after you sign up for Medicare Parts A and B, then that's when you can sign up for a supplemental plan, a Advantage plan, or a drug plan. And then also, another important date is the annual enrollment period. This is where the billboards come out. You get the trucks, the Blue Cross trucks driving around. And that's the open enrollment only if you're on Medicare. So if you're working at URI, don't worry about this time frame. Don't worry about the mail that you get. It's not going to affect you. But if you are currently on a Medicare plan, a drug plan or a Medicare Advantage plan, this is the time, October 15th to December 7th. That's when the new plans for the following year come out, and you get to decide whether you want to stay or you want to change. My advice is just because you like your plan this year doesn't mean it's going to be the same plan next year. So make sure that they send you a big packet. Again, call our office, happy to help you through the process. And the next question that a lot of people ask is, how am I going to pay for everything? Do I set it up? Do I mail them a check? What do I do? So with Medicare Part A, you don't get a bill because you don't owe them anything. And Medicare Part B, if you're collecting Social Security, they're just going to take it directly out of your Social Security check. If you're not collecting Social Security, they usually bill you quarterly. So you get a bill every 3 months for $402 for your Medicare Part B, until you start collecting, in which case they'll start taking it automatically. Medicare Advantage and Part D, these plans can actually come out of your Social Security check directly as well, just like your Part B. Or you can pay for them on a monthly basis. Some plans will take credit cards. And then for your Medicare Supplemental plan, unfortunately, one of the few ways to pay for it is either by paper bill every month or get it taken out of your checking account. So let's talk about, again, late enrollment penalties. I just want to go over the penalties with you so that if you meet up with friends that are going to talk about this, we have this game that we play whenever we go to a restaurant and we see a group of people sitting around. We time how long it takes before people talk about healthcare and healthcare expenses. And usually people start talking about healthcare, and then it's like, oh, I'm on Medicare, or my mom's on Medicare, and you can't believe this, and there's all these penalties. And so I'm just going to go over it so that you're going to be pros at dominating those types of conversations. So with Medicare, there's two major penalties. One is for Part B, and the other one's for Part D. Part B is not very common just because the transition that people do through URI is usually really good. I don't think we've ever had a case where somebody had a Part B penalty. The only time when you have a Part B penalty is if you don't sign up for Part B and you don't have insurance. So if you're uninsured and you don't have Part B, you're going to get penalized 10%. That's 10% per year tagged on from when you do sign up for the rest of your life. So if it's a year, 10%, 2 years, 20%, 3 years, 30% for the rest of your life. The other thing that people get caught up on is with COBRA. So again, rarely happens here, actually no cases here, but in some organizations, they'll give you a severance package for you to leave work. And part of that severance package will include usually a year and a half of medical benefits. And it's just as good as the plan that you had before. In those situations, unfortunately, the month that you leave payroll, your plan is no longer counted as credible under Medicare terms. So if you have COBRA, COBRA is actually not considered credible coverage under Medicare terms. So if you're on a year of COBRA and you don't sign up for Part B, you will start incurring that penalty. So if you do have COBRA, if you do decide to go on COBRA for one reason or another, you have 8 months to sign up for Part B after leaving work before you start getting penalties. And then Part D, that's the most common penalty that we see just because we have a lot of people that will say, hey, I'm not on any medications, why should I buy a drug plan? So if you don't buy a drug plan, for every month that you didn't have a drug plan, you will be penalized 1%, so 12% a year of the national average. Today it's about $35. So you're incurring about close to a $4 penalty a month tagged on for the rest of your life when you do sign up. So we recommend that you just pick up the lowest cost drug plan. As of today, it's somewhere around $12 a month just to avoid the penalties. You get some extra coverage just in case if you need antibiotics or so forth. So I wanted to highlight the plans available through the university and also the state. So these are the plans that Pat was referring to. So the state of Rhode Island gives you the option of choosing between two United Healthcare plans. One is the Medicare Advantage, the ones with the copays, on the left, the HMO, and then the other is the supplement, which is the Cadillac plan, which allows you to go anywhere. Most people we see tend to, even though the Advantage plan is ironically more expensive, we see that more folks lean towards the Plan 65 just because you don't have to worry about the networks. You can go up to Boston, you can go anywhere you want, and also you don't have to pay any copays. The downside is that you have to purchase a separate drug plan, spend some more money out of pocket, and also it doesn't include a lot of the ancillary benefits like the gym memberships or the preventative dental and so forth. But again, it's more, the Plan 65, the Supplemental 65, it is more coverage, more flexibility, less frills, versus the HMO plan. No referrals with that HMO plan, so you don't have to get a referral from a primary care doctor. But in Rhode Island, the network is about 80% versus 80% of doctors, specialists out there versus about 99% for Medicare in Rhode Island. And then you're going to have out-of-pocket expenses as well. You know, $10 at the primary care, $30 at the specialist, that $150 per day at the hospital, nursing homes $20 per day, emergency room, and out-of-pocket expenses as well. So, so usually we recommend that you choose one of these options if you're in a situation where the universities pay for your healthcare, right? Somebody else is paying for it, go for it. But if you are paying full price, so the full price for the Advantage plan is $268, that's actually pretty high. The supplemental plan is $195. If you are going to be paying the full price, then we just recommend that you reach out to us because we can certainly help you take a look at the individual options available. Oftentimes you can find that you can find a similar plan for a much lower cost, depending on your age. And also we can take a look at the Part D plans for you as well. All right, so let's take a look at what's available to the general public. Just some names so that you're familiar with what to expect. In Rhode Island, there's only two big companies that control most of the markets, Blue Cross and United. That's it, at least for this year. For the drug plans, you've got the 21 different drug plans. Some of the common ones, you're looking at Humana, which has that Walmart plan, SilverScript, which is a plan that's owned by CVS. So I just wanted to make you aware of some of the names to pay attention to. And both United Health and Blue Cross have supplemental plans as well as Advantage plans. So it's not really what company to choose. It's figuring out whether you're going to go with the supplemental route or the Advantage route. Once you figure that out, then it's comparing the companies, because then you can really have an apples-to-apples comparison. So that's about vision. As Pat said, best deal for vision and dental, do the COBRA for 18 months. And then we can help you figure it out later on. Dental plans, individual dental plans. There's Blue Cross, there's Delta. Those are the two big names out there. Delta, you got to go through AAA. Blue Cross, you can go directly. Ballpark pricing for something similar. So there are lower cost dental plans, and typically, so if you see a dental plan that's advertised for somewhere around $20, typically those dental plans are not very robust. They'll just cover you for the basics. Your cleanings, checkups, x-rays, maybe some fillings, extraction, that's it. Any dental plan that's going to cover you for anything major, the root canals, bridges, crowns, so forth, you're looking at least a $40 to $60 price range per month per person. So again, a lot of times it's going to be really tempting to look online and just tell you $0 cleanings, $20 a month. I would really advise that you take a look at the fine print. And then also we see after doing the COBRA, a lot of people just end up paying cash for dental, because if you're pretty healthy, your teeth are pretty good, you just go for your 2 cleanings and checkup every year. The average price of somebody that pays cash out of pocket for 2 cleanings, checkup, x-rays every year is about $300 at the dentist. Cleanings are about, we had our office call 100 dentists just to see how much their cash prices were, and it was somewhere between $60 on the very low end to about $120 on the high end in Rhode Island. Massachusetts a little bit higher. So be nice to your dentist if you want the cash deal. In under 65, definitely COBRA tends to be if you don't qualify for subsidies, meaning your income's not low enough to qualify for a tax credit from the Obamacare exchanges, then usually we find that the COBRA is the best deal when it comes to getting really robust benefits for the price. But if your income is low, and low meaning that typically under about $60,000 a year after retirement, we would look at HealthSource Rhode Island. Sometimes you'll be able to get a subsidy, get some discounts on a plan, can be a lower cost for you overall. But unfortunately, typically the HealthSource Rhode Island plans, as what Pat was mentioning, they are going to be higher deductible. Usually we see $3,000, $5,000 deductibles, so that's something to brace for. So what is Doctor's Choice? I want to quickly go over our story of why am I here and how we got started. So Doctor's Choice actually started as an academic exercise out of Brown Medical School to help educate patients about Medicare. I was in a primary care office, and Obamacare was coming out. About a quarter of the patients we were seeing were on Medicare. They were really confused, and I didn't have a good solution to really guide them through the process. So initially this presentation was about 100 hours of research. I figured if I can do 100 hours of research from my background, if I save somebody 100 hours of time, then that's a win. And it was 100 hours distilled down to a 40-minute presentation. This is probably version 300 something of this presentation. And our goal is to really just help provide unbiased education to help navigate you through the Medicare process. We do have So we have seminars like these. We have a very active website with a lot of educational materials for you to navigate through Medicare. And once you're ready, we do have a staff that's able to walk you through the Medicare process one-on-one at completely no cost to you. So our services are free, and how we are funded is we work with all the various insurance companies. So when we help you enroll in a various plan, the companies pay us. The prices are exactly the same whether you go through us or go through the companies directly. So, but you get the added level of service, and we also can help you through a lot of the issues that happen with Medicare. So unfortunately, about 5% of the cases, you can do everything right, and something can go wrong with Medicare, just because you're dealing with you're dealing with multiple parties. Right? You're dealing with big insurance companies, even though and also so we have a office right across the hall from Social Security in Warwick, so plenty of parking, which is great. And that office is actually they're wonderful, so we can get issues addressed pretty quickly. But again, no cost consultations to you. We also have an online course, Doctor's Choice U. We did put a price on this, but everybody here is going to be able to get access for free. So if you are interested in taking our online course, it's an expanded version of what we talked about here. We also have state-specific courses, meaning that if you're thinking about moving to Massachusetts or California or Florida, we have modules for each particular state. So you can look at what the rules are, what the average prices are, what are some of the most common companies you should look at. And we can help you look at all those companies too. But some people like to do just their pre-research. So if that's the case, feel free to send me a note through our website, and we can give you a coupon code so you can get any of our courses for free as part of being part of URI. And then the other thing is just getting in touch with us. Feel free to reach out to us with any questions. We do have people in the office during all business hours, and we're able to accommodate nights, occasionally weekends if your schedule is really tight. We do have team available. Our offices are in the Social Security building in Warwick, 30 Quaker Lane, and right on the first floor, so no stairs. And we also have a very active Facebook page where it's not about Medicare, because you can only, again, talk about Medicare for so long before you start quitting. So what ends up happening is that if people have a lot of, so we usually see that people have similar questions. And once we get enough of the same question, we do educational videos, articles, and share resources about solutions to that particular answer. So for example, one of them was how to get medications from Canada, because people were asking a lot of questions about, my medication is really expensive, how much is my prescription actually cost in Canada, and how do I go about getting it? So we did a documentary, drove up to Niagara Falls and figured out how to buy drugs. So it was really weird to explain that to Border Patrol, but they end up realizing that medications in some cases can cost you about 1/4 of the price in Canada, but not always. So educational content like that, you can like us on Facebook and continue to get updates. LinkedIn, and then also, we don't really tweet, so. All right, and I'll open it up to any other questions. Yes? Oh, just go on our website. You can send us a note. There's a contact us button. And send us a note, and we'll email you a coupon. Yep, you got it. Yes? Oh, that's with the HSA. So not a lot of people are on the HSA plans, right? Okay. So yeah, if you're not on an HSA plan, then don't worry about it at all. But if you are, then the takeaway is stop contributing 6 months before you're ready to retire, because there's a 6-month look back, and you may be liable for taxes.
So you might not know this answer. For our HSA plan, the state funds it. So how does that work? You wouldn't be able to take the state's second funding because it does it twice a year.
Yeah. So in that case, it might be counted as ordinary income. Yeah. So the question is, well, if the state funds it, then what happens to that money? So it might tax. I would definitely talk to your accountant. It might be counted as ordinary income, taxable income. Yes.
I keep hearing that January 1st, 2020, some of the Medicare supplemental plans are no longer available.
Yeah. So we just did a video on our Facebook about that. So yeah, 2020, people are concerned because Plan F, what they call Plan F, is going away. So with the supplemental plans, right, A through N, Plan F is actually has been the most popular plan, just because Plan F just covers you 100%. You don't even have that $183 deductible. Because MACRA, which is the Medicare Authorization Act, they're saying that we're getting rid of all first dollar coverage. So you can't have a plan that covers you 100% first dollar anymore after 2020. So the thing is that if you end up on a Plan F before 2020, you can still keep it, you're grandfathered in, but anybody that's going into Medicare after 2020 will not be allowed to go on a Plan F anymore. It's more so of I think a lot of articles are using it as a way to just generate more attention versus it actually being very substantial or practical, because the alternative is Plan G. The only difference between the two is it's a $183 deductible. And oftentimes what you'll see is that the Plan G prices on an annual basis, you save more than $183 to go on a Plan G versus a Plan F. So it's almost like a no-brainer to go on a new plan and save more money guaranteed than to stay with the old Plan F. Yeah, so don't worry, nothing great is going away. You'll still be able to get really good coverage. Yes?
So often when you go to the doctor's office, they kind of pay a whole lot of attention to it. They have signs about who don't cover, this company, that company, whatever. Are those for the supplemental plan or the advantage plan?
Yeah, so a lot of doctors' offices, especially in Rhode Island, they will say we don't take AARP for Medicare, and what they mean is that it's the United Medicare Advantage plan, so Part C. So if you're on an AARP supplemental plan or you're on the Plan 65 from URI, the United plan, you can still go see those doctors as long as they take Medicare. That's fine. It's just the plans. If you were on the other plan, the Medicare Advantage plan, and you go to a doctor that doesn't take United, then unfortunately you can't see them. But yeah, supplemental plans, you're okay. Go to any doctor, doesn't matter what company it is. All right, any other questions? Great, now I'll stay afterwards as well if you have any personal questions to answer. Okay, great. So I have the pleasure of introducing Dan Sampson from TIAA-CREF, who's going to teach you how to be a millionaire in retirement.
Okay, I think we're good to go. My name's Dan Sampson. I've met with a few of you in the past. I'm a financial consultant with TIAA, and I'm going to introduce Justin in a second, but just to give you a sense as to what I do and what Justin does, again, my title is a financial consultant, and my relationship is at the institutional level. So I'm sort of an extension of the HR office. I come on campus 3 times a month, and every time we come on campus, we offer 7 appointments that day. So 21 appointments every month is what I offer here on campus. So again, the group I'm in at TIAA is called Institutional Financial Services. Oh, thank you. So my relationship is with HR and serving the employees of the institution, but no one individual is actually assigned to me. You can come and meet with me as often as you want, but Justin's in a group called the Individual Advisory Services, and I'll give him a second to introduce himself, and then we'll get on with the presentation.
Great. Thanks, Dan. So what my role is with Dan, and some of you I know in this room, is that if there are situations that Dan identifies within your personal financial situation, he'll refer them to me or one of my colleagues in Providence, and we can actually go through a more extensive planning process to go through that. Or if you have specific questions or looking to should I buy this? What does this look like? How does this impact my retirement? A lot more in-depth planning. That's where I'll work closely with Dan.
Thanks. Excuse me. So the first thing I want to tell you has nothing to do with why you came here today, and that is your beneficiaries. I bring that up because I meet with about 800 people a year, and I'd say at least 30% of the time, beneficiaries are not accurate. They're either your ex-spouse, or they're set to the word estate, which means that if you died, it would go to probate court, or they're inconsistent. So there's any number of reasons how they can be off, but I would encourage you to go online, check your beneficiaries, and if they're not accurate, go ahead and change them. If you're not comfortable doing it online, we can certainly make a form available to you as well that you can send in to us through the mail, right? So the presentation today has to do with income options, but before we get into the details of the actual income options that you have, we just kind of want to set the stage with planning for retirement. So the things we're going to cover today, we're going to describe what we mean by the term income floor. We're going to talk about the different types of investments that that might help you fund retirement. Could be a pension, could be your 403b, Social Security, et cetera. Then we're going to get into the details of how you take your money out. What are your options? Now, when we talk about the different types of income that you might have available in retirement, we're not going to be talking specifically about TIAA. So some of your assets may be outside of TIA. So we'll talk about IRAs and 401ks, et cetera, in general, and then we'll come back and talk about the income options specific to TIA. So when we talk about the income floor, what we're referring to is the basic necessities that you need to pay for in retirement. Everybody needs food, everybody needs transportation, you need to pay for the utilities at your house, et cetera. So those are basic expenses that you need to spend money on. So we need to first establish the income floor before we can talk about other things that you might like to do. All right, so these are some of the examples that you need to make sure that you have enough income to pay for. Once you assure that you've got those things covered, then you can talk about the things that you'd like to do. You know, do you want to spend a month in Ireland, or do you have an expensive hobby that you'd like to, you know, enjoy during retirement, et cetera. So what we're going to get to in a second is itemizing those. You know, a lot of people come to the meetings and they'll bring either a piece of paper that they wrote on or maybe a spreadsheet that they put together. And typically there's a lot of items that are not on there. Sometimes I see people come with a piece of paper and it's got 7 items on that. This is what my cable costs, this is what my phone costs, and there's so many things that we kind of forget about. We forget about life insurance or long-term care insurance or property taxes, et cetera. So what Justin's going to do, he's going to talk about a budget worksheet that we suggest you go through. It's actually in the second book, the Bound book, Spiral Bound book, and I'll let Justin go through that.
Great. Thanks, Dan. So we had handed out this booklet here. Let me just get the front of it. Should be the one that's the Bound book on there. And if you turn to page 4, it'll have a monthly budget expense worksheet. And on this worksheet here, what we try and do, as Dan was saying, so you have your basic needs within retirement. You know, whether it's monthly expenses, food, Medicare payments, taxes. You know, we'll talk a little more about taxes later, not that we're tax experts, but anything along that line. Those are your basic needs that you have to have in retirement. So that's where you have on there. And it's always an interesting exercise. I've been in this business for 28 years, is when I sit down with spouses and then you get to the next column on the right that says discretionary. It's always interesting, especially this time of year. A lot of people would say, there's no way I'm spending another winter in Rhode Island after this winter. So, but those are areas where you would put in what we call, wishes. What are your wishes? You know, as Dan mentioned, was that maybe spend a month in Ireland, or look at spending somewhere warmer. Might be a wish to fund education goals for grandchildren, or any other wishes. And then you will also have what we call dreams, where you could have that as be able to leave money to legacies or really do something impactful into anybody. So we're not going to go through this here, but this is a very important exercise that Dan and I take our clients through, because it does generate the income floor and has that as an ability to give us an idea so we know what the income is and where it's coming from, and how do we begin that process. Did you want to have me keep going? Okay. On the next page, next slide, did you give me the... Oh, all right, you're already there. Okay. So there's the different areas that you would look at the sources of income to be able to see that. So we know Social Security. A lot of our clients have most of their income is in their defined benefit plan, what we call 403B, which many of you have, or a 401k. You also have some types of defined benefit plans, which could be pensions. You also have individual retirement accounts, annuities, which we'll talk more about that later. Sometimes I know that can be a voodoo word in our industry, because some people have had bad experiences with annuities, but we'll talk more about that. And then you also have other investments in savings accounts outside of, whether it's in a money market account or other investments you may have elsewhere. So when we talk about what's viable and still reliable, we hope. I know we heard our Social Security presenter earlier that Social Security is going to be around well past I think it was 2034. She said. I hope it'll be much longer than that. But typically we identify income traits. We have taxable fixed monthly income from the government. Obviously, that's your Social Security and your pensions. Income options. People most likely have you work for entire career, 40 years, and all of a sudden your paycheck goes away. It's another way people like to have surety. They want to know what are income options I can have a guarantee to. The other thing we want to be aware of and be cautious about is that when you have other benefits, if you take that, we know that you can have a Social Security benefit that's taken, you can be reduced. Obviously, we know we can have a more substantial benefit if you were to wait till full retirement age, and then also too, spouse gets a benefit too. How and when do we do that? What's the best way to do that? These are things that we talk through our clients and be able to plan for what income's needed and what income is coming into your household. And then when we look at 401ks and 403bs, we want to look at your options. A lot of people, when they do retire, they want to know what their options are. Can I move my money out of my plan? Can I put it in? Can I leave it where it is? The investments that you have all the years you've contributed to are good investments. But some people like to know, I like to have more options. So what are your options to start to take that income? One, you could roll it into an IRA where you can now take your investments. It's a tax-free event. Where it would roll over, you can leave those investments. You can have those investments diversified under different types of options. I have clients say, geez, I'd like to buy Vanguard funds. How come I can't buy them in my plan now? There are the ways to do that. You can, as I said, leave it alone. Some clients say, I like what it's done. I've accumulated a lot of wealth. Absolutely leave it alone. Take periodic distributions. We want to make sure when you take those distributions, how do you take them? We're able to help you do that. Where do I take it from? I had a lot of questions last year. People said, I want to take all my distributions out of my equity portion because it did so well, the market up. Maybe that's not the best strategy. So we help you plan for that. Annuity, lifetime income. There's different ways that you can take the annuity through your TIA traditional. You can take that income over a lifetime benefit, and we can talk more about that if that has an interest to you. But it gives you a guaranteed benefit to you while you're alive and to your spouse and potentially to your children. So that's another great option. Or you can do the lump sum withdrawal. But we caution against that, because if you take your money all out and it goes into the form of your checking account, that is a taxable event. So if you are looking to take your money out and wish to roll it over to another institution, we either have it go into an IRA first, which is a non-taxable event, and then put that into a transfer if you wish to go to another service provider. Looking at the defined benefit plans, when you look at these are different options. When people look at, they say, well, these are older plans, and you look at pension plans that are out there. So they're typically more the older plans that really have kind of gone away. But these are some of the employer placed in a managed account. When you look at the different formulas out there, they're typically based upon the fixed benefits on a formula given to you when you leave or retire. That's typically, sometimes I've seen those with clients. They come in with a letter and say, this is my pension benefit. It's figured by the actuaries at the company. So that's typically, and you really see those a lot today. You don't, most of these have gone away. These tend to be more of a dinosaur plan today. They're typically funded entirely by the company, which can create some uncertainty. There's been some hospitals here in Rhode Island in the last couple of years that are no longer with us, and some people now have their pensions reduced. So there is you could have some vulnerability there to your payment to be able to do that. I'm not trying to say that companies are on bad footing out there, but how are they determined? It's not on best performance. Length of service is typically earnings history. It's not an individual account. These are pooled assets. Sometimes these are called profit-sharing plans. It's another way to be able to determine these. But also, too, it's benefits may come out of the company income if they underperform. That's depending on how the company's doing. So there's a lot of, again, these are older plans that typically we don't see a lot. And then, obviously, there's a maximum benefit on there. So, but if you do have those, there are options that we can talk to you about. If you wanted to take ownership of it, you can always look at rolling that over or keeping it with the company to be able to do it. Maybe the benefit's a great benefit.
Okay, the next two slides are on IRAs. There's several different types of IRAs, but primarily the main ones that people know about are what we call the traditional IRA and the Roth IRA. So this slide has to do with the traditional IRA, which I think back in the day used to just be called an IRA. But in 1997, when the Roth IRA came into being, they had to come up with a different description for that old IRA, so now they call it the traditional. So it's been around much longer than the Roth. And you know, many of you may have these. You might have them with TIA, you might have them outside of TIA. Typically money gets in there either because you've contributed to it. Maybe during tax time you went to the accountant and they said, well, if you put $4,000 into your IRA, you won't have to write a check. And so you may have contributed to it now and again, or you may have rolled assets into it. All right, so if you have an old employer plan, 401k, 403b, whatever, and as Justin said, maybe you like certain funds, whether it's Vanguard, whoever, you can roll that old employer plan into an IRA. So it is taxable. The money that went in was not taxed. You either took it as a deduction at tax time or you rolled it from an employer plan, so that money has not been taxed. And when you do take it out, it will get taxed as what they call ordinary income. So most of this income that you're taking out of your employer plans, your IRAs, et cetera, is taxed just as though it was money that came from a job. All right? The term for that is ordinary income. As far as the income options, as Justin said, you can take it in a lump sum, not recommended if you take money out. And sometimes people will want to take out their money because they want to put it in the bank so that it's close by. You know, maybe they're risk averse, they want to put it in CD, plus they want it to have in the bank so it's close by. Well, if you just cash it out, let's say there's a $100,000 IRA, it's $100,000 of taxable income in that year. Not typically advised that you do that. Periodic distributions, most things that aren't in annuities or pensions where you where you don't control what the disbursement is, you can take in periodic disbursements. Most of us think of our bills as monthly. You know, we pay the phone bill, we pay the mortgage if you have one, et cetera, monthly. So a lot of times when people set up periodic disbursements, which TIA refers to as systematic withdrawals. So most people take them on a monthly basis. You can take them quarterly, semi-annually, et cetera, but the most common is monthly. And most common is for us to direct deposit that into your account. When you take a systematic withdrawal, a monthly disbursement, you're not locked into that amount. You can change that up or down, stop it, redirect it to a different bank. So it's totally under your control. Most of these requests, when you want to initiate them, can be done by phone. So it used to be everything was on paper, and now as much as possible for your benefit and for ours, most things can be transacted on the phone because you're on a recorded phone line when you call our support center. All right? If you called me, I couldn't do it because we're not on a recorded line. You can roll it over. So as Justin said, when you're moving money between retirement accounts, whether it's considered a rollover or direct transfer, it's going from one pre-tax account to another. That's perfectly fine. What throws some people off sometimes is when you've done that and you've been told that it's not a taxable event, the following January you'll get what's called a 1099-R in the mail. And it says you distributed money. And I've gotten some calls in January saying, hey, you said it wasn't a taxable event. That's just a document that reports that you did a rollover, but it is certainly not a taxable distribution that you took. If the IRA is in an annuity, then you can do what we call annuitize those assets. Some people, and hopefully none of you have this perception, but some people come to the meetings and think that their question to me is, what is TI going to give me for the rest of my life? Thinking that that's the only income option, that they've saved with TIA all these years, and then we're going to dictate, based on your balance, what we're going to pay you. And that is an option, but it's not the only option. You have all the same withdrawal options on your accounts with us that you have in any type of investment, like a mutual fund, et cetera. You can take lump sums, systematic distributions, et cetera. So why it says Investment Solutions IRA up there, that's the name for our TIA annuity. It's called Investment Solutions, so it's an annuity IRA. If you take distributions before age 59 and a half, there's a 10% early withdrawal penalty that is assessed by the IRS. There are exceptions to that rule on employer plans. So if you, let's say, are 57 years old and you decide to retire and you think you're going to start needing to dip into your 403B, one of the exceptions to this age 59 and a half rule is that if you leave your job at age 55 or later, if you take distributions from that employer's plan, not from IRAs or other places, but for that employer's plan, you wouldn't be subject to that 10% penalty. Minimum distributions. At age 70 and a half, the IRS says if you're not working, then you have to take minimum distributions. If you are working, then you don't have to take minimum distributions for that employer's plan. But if you have IRAs, you would have to take minimum distributions. Okay, so if you are over 70 and a half and you're still working at URI and you have a 403B that has $400,000 in it, you don't have to take required distributions because you're still employed. If in addition to that you have an IRA that, let's say, has $200,000, you would have to take required distributions from that. Occasionally I do run into people who just didn't know they had to take them. I had someone here who was 76 and had never taken a minimum distribution, no longer working. And so if you don't take the minimum distribution, there's a 50% penalty. Okay, so let's say your required distribution at age 71 was $4,000 and you didn't take it, you still have to take the $4,000 and pay a $2,000 penalty. Okay, I can't give tax advice. So with that particular person that I'm thinking of, we called our support center, figured out what they were supposed to take out all those years, and we distributed that. So they did it in good faith. As to whether they paid the penalty, I don't know. That was for them and their accountant and the IRS to figure out. So hopefully the IRS is nice that day and says, all right, you didn't realize we won't charge you the penalty, but it is in fact expensive if you don't, if you do make that mistake. Yep.
We have to apply for the mandatory distribution, or they automatically give us the distribution?
When you say they, you mean TIA? Yeah. No, you do have to contact us, and here's why. Because let's say you have a 403B with URI, but you also have a 403B with Brown University through Fidelity, let's say. What the IRS allows you to do is they allow you to calculate the minimum distribution on both of those accounts, but then just take it out of one. So in other words, if you were supposed to take out $4,000 from your URI 403B and $2,000 from Brown, you can calculate those two amounts and then take the $6,000 from Brown. So TI couldn't assume that you actually want us to distribute that amount of money. Okay? So that's why we wouldn't automatically do it. What we do is about a year before you turn 70 and a half is we do send you a letter and say, heads up, you need to know about this. But ultimately, as much as we want to help you with that, it's your responsibility. All right? One of the things that we'll talk about later is that we will actually, we'd be happy to set it up one time where you say, just automatically send it to me. So you could fill out a form, say, let's set up minimum distribution, and every year we will calculate it and send it to you. So that is an option. All right, the Roth IRA. How many people have Roth IRAs? Okay. So the contributions that go into a Roth are after-tax contributions. So there's no immediate tax benefit. When you open up a Roth, you can't claim it on your taxes and assume that your taxes are going to go down. So the money that goes into the Roth goes in after taxes. So why would you do that? The reason for that is that the growth on that Roth is tax-free growth, okay? As long as you play by the rules. So technically, it would be correct for me to say that the growth on the Roth is tax-deferred, all right? It becomes tax-free if you take withdrawals when you're allowed to. In other words, when you open up a Roth, the rules on that are you either have to keep it for 5 years or age 59 and a half, whichever's later. So that's when it becomes tax-free. All right, so if you're 52 years old and you open up a Roth, you can't touch the growth of that money until age 59 and a half without penalties and taxes. That's when it becomes tax-free. If you're 58 when you open up the Roth, you have to wait 5 years before you can take it tax-free. Okay, so 5 years or 59 and a half, whichever's later. Now, the contributions to the Roth can be taken out at any time. All right, so if you put in $5,000 a year into a Roth for 3 years, you put in $15,000 total, and let's say it's grown to $17,000, and then you need the money. I can speak to this firsthand. A divorce many years ago made me tap into the Roth. So as long as you're only taking out the contributions or some amount of those contributions, not a problem. Once you start tapping into the growth before 59 and a half or, and 5 years, then there's penalties. Now, unlike most retirement plans, there is no required distribution on a Roth. So you could let that sit and grow for as long as you want. Some people do that because they want to pass it on to the next generation. So it's a great way to leave a legacy. And sometimes if you're investing for the next generation, even though we might be 60 or 65, you might still want to consider being more aggressive with that money. You know, some people at 65 think, well, I should only have 30% of my money in stocks or thereabouts. But if you say, I'm going to pass this on 20 years from now, you might decide to be more aggressive because the money's really for the next generation. The other thing I would say about allocations to a Roth, if you're going to take risk anywhere with your money, whether it's in the 403b or the Roth or wherever it is, the first place to consider taking that risk is in the Roth IRA, right? Because we take risk to get a return. So you have some money in stocks hoping that that money is going to get 7 or 8 or 9%. Well, it'd be best if that 7 or 8 or 9% return was tax-free, okay? So instead of maybe if you come up with an allocation that you want, let's say 60% stocks, 40% bonds, instead of applying it across all of your investments, maybe you said, all right, I'm going to get higher risk exposure in the Roth and then decrease my risk exposure somewhere else, right? Again, I meet with a lot of people come in with Roth IRAs, but they're at the bank. You know, I have a Roth IRA, it's in a CD earning 1.25%. I'm like, let's kind of reposition that. Let's think about where it's best to put that Roth money. The fact that there's no required distribution is for the owner of the Roth. Once it gets passed down to your beneficiaries, it does become necessary to start taking distributions from that Roth. All right, lifetime annuities. As I said, annuitizing your account is strictly an option. It's an option that I think too many people dismiss right off the top and say, I don't want to talk about it. As Justin said, the word annuity triggers a lot of different thoughts when people hear that. It gets a lot of negative press, and a lot of the negative press has to do with high expenses and difficulty in getting your money out. So, and those two aren't true with TIA, but it's very true that you could buy an annuity and be paying 2 or 2.5% per year for that annuity. And then if you try to get out, they might want you to pay a 7% penalty to get out of that. So annuities deservedly sometimes do have a bad rep. All right. Like I said, those two things don't exist with your TIA accounts, annuities. But that's, with an annuity, there's two phases. There's the accumulation phase and there's the payout phase. So in the accumulation phase, you're adding to it, you're investing it, you're hoping it grows, you might be paying a high expense, but you're in the accumulation phase. The payout phase is more what we're talking about here, is do I take my annuity and actually give up control of that money? Do I take some or all of the money that's in my annuity account, transfer it to the insurance company in exchange for lifetime income, right? That's the part where I was saying a lot of people dismiss that out of hand because they just have a bad taste in their mouth about what an annuity is. My big thing about all this financial planning is learn as much as you can and then make your decision, right? See what you would get from an annuity. See what the pros and cons of doing that are, and maybe it's a better fit than you think, maybe it's not a good fit, but without sort of going down that path to see how it works, you're not necessarily giving yourself the option to see what might work best for you. All right, we talked about the income floor earlier. Like, how do I meet my basic needs? Social Security is going to be part of it. Maybe you have a pension, but if your income need is $4,000 and Social Security is $2,400, where's that other $1,600 going to come in that you can sleep at night and go, okay, I know this money's going to come in and my basic needs are met, right? This is one of the things here that I was talking about is when we're in this section here, these aren't specific to TIAA. So when it says surrender charges may apply, that's with annuities in general. That doesn't exist with TIAA. Okay, this might be the main reason why you came here today, and that is, how do I get my money out of my TIAA accounts? The second brochure that we handed, the one that's not spiral bound, has all of these investment options explained in there. And before I forget, there's also a tool, a calculator that you have available to you on the website. It's called Retirement Income Planner. Does anybody use that? Okay. Very, very powerful tool. It takes a little getting used to because it's got so much there, but it's very, very helpful. I use it a lot in our meetings as well. It basically will allow you to, with your account, say, all right, what am I going to get if I take, an interest-only option, or what am I going to get if I do what's called a transfer payout annuity? And this Retirement Income Planner will allow you to get those numbers. Okay, so I'd be happy to go over it with you if you set up a meeting to come in. But these are the 5 different ways to take money out of your account. The 2 that are in gold, the TIAA interest only and the transfer payout annuity, those have to do strictly with the TIAA traditional money that's in the RA contract. All right? So your RA contract, RA stands for retirement annuity. That's the mandatory account that you all have. You're putting in a mandatory 5%. The school's matching 9%. That's all going into your RA. If within that account you have placed any of your money in the TIAA traditional, I can tell you 2 things. It's earning a very, very good interest rate, and it has a very nice guarantee of 3%. In exchange for that, there's some withdrawal rules that you have to abide by. The main thing that you can't do with the TI traditional is take lump sums out of there. All right, so if you have an RA contract and it's got $400,000 in there and $200,000 is in the TI traditional, and you called us and said, I'd like to get $50,000 out of the TI traditional, unfortunately you can't do that. Okay? I usually make sure when I have meetings with people to have money in TI traditional, especially people if they get nervous about the market, is that before you move money in there, understand the ramifications of doing that, right? So if you're concerned about the economy and the political environment, you say, all right, I'm getting out of stocks, that's fine, but the next question is, all right, where do I put that money? If I'm getting out of stocks, where do I put the money? Do I put it in bonds or do I put it in the guaranteed account? As long as you understand how you're going to be allowed to take money out of that guaranteed account, that's fine. So the quickest way to get money out of the TIAA traditional in the RA contract is with that transfer payout annuity. That's an irrevocable decision. When you set that up, what you're going to get is 10 equal payments, 10% a year. Okay? That 10% payment can go anywhere. It could come into your pocket, go into your bank. It could be rolled over to an IRA. It could be moved from the TI traditional in the RA to another option in the RA. All right, so there's a lot of different places you can put that. Also, you can change where it goes. Let's say for 2 years you're getting that 10% withdrawal direct deposit into your bank, and then you realize we don't need this money anymore. You can call us and then redirect it into some other investment within the RA so that it's not taxed. Okay? So you can always change where it's going. You just can't change the fact that it's in effect. Yes?
If you were to do that, and say you were to take half of your TIAA, what is the interest rate that's guaranteed on that TP, or that transfer amount of money? It's no longer 3%.
Right. So there was kind of two questions there. One was if you take some of your TIA traditional money out and put it in a TPA. That's a good point because, you know, there are withdrawal rules and people sometimes are surprised by them or concerned about that. But you don't have to do it on the full amount. So in other words, if you have $200,000 in your TI traditional RA, well, hopefully we're all going to live longer than 10 years. And the question is, well, once I do that, it's exhausted. What happens? You can take a partial amount. So if you have $200,000 in your TI traditional, you could call us and say, take 80,000 of that and give me 10% of that every year. So it's good that you said, what if I take some of my TI traditional? As far as the interest rate, we basically, let's say you're earning 4.5% on that TI traditional. And you know, you would earn that over the course of the 10 years. What they do is they calculate what interest you would earn over time, and they bring that forward. All right. So let me say it a different way. If you had 80,000 that you started a TPA on, you would think 10% is $8,000. Well, if the 80,000 is earning, let's say, 4.5%, you might in fact get 9,500 a year. All right. So you're not getting 10% of the 80. You're getting 10% of the sort of total value that that money would earn over time. Okay. That is one of the things that you could use that retirement income planner tool for. If you go in there and say, what would happen if I did my transfer payout annuity on my 80,000, what would I get? And we'll tell you what you would actually get paid out. Well, yeah, it is guaranteed at 3%. Yeah, you'll always get the guaranteed 3%. Yeah. No. But like I said, what we do is we basically pull forward, you know, the interest that you would have earned and then give you equal payments over those 10 payments. Now, one other thing that is a pretty cool technique is that some people have most or all of their money in that that TI traditionally RA. And they're going into retirement, and they may have another 50, 100,000, whatever, outside. So they'll have some money liquid, but the concern at that point is, oh, great, I've had all this safety, I've earned some great interest all these years, but now I need to make this money liquid. Well, if you don't already have one, there's a second account that you can have with us called a GSRA. The S stands for supplemental. So the 5% that you're putting into the IRA is mandatory. You can put in another $24,500 on a supplemental voluntary basis, right? If you don't have one already, I would set one up before you retire. What it gives you is some flexibility. So we know that if we have money in TI traditional in the IRA, we can only take it out 10% a year. But we don't necessarily need all that money. We just need to start making it liquid so that if we do need, let's say, $100,000 to go buy a condo in Florida, we have it. So what you can do is you can start this transfer payout annuity, 10% a year, and instead of withdrawing it, you can just shift it down to the supplemental account. So you can move it from TI traditional in the RA to TI traditional in the GSRA. The key point is the GSRA money is liquid. So if you have money in the TIAA traditional in the supplemental account, it's completely liquid. All right? The trade-off is the interest rate's a little bit lower. All right? Still has the same minimum guarantee of 3%, but the current interest rate is typically 0.5 to 0.75% less. So when you're working, maybe it's more important that you earn the high interest, but when you're retired, it's more important to have access to the money. So it's something that a lot of people set up where they start the TPA, the transfer payout annuity, and they just have us move that money from the RA to the GSRA so that they start building up a liquid pool of money. All right.
Did you talk about the minimum age? It says minimum 50% option.
I didn't talk about it, but we're going to, let's go to that one next. No, that's fine. Doesn't matter which order we take them in. This is what I was referring to earlier. If you just want TIAA to automatically take your required distribution out every year and send it to you, we'd be happy to do that. So again, usually something we can do on the phone. Sometimes it requires a form, or at least sometimes we're required to get a waiver of some kind, of spousal waiver, something like that. But so you can call us and say, you know, I don't really need the money, but the IRS is forcing me to take it out. Just take it out, let's say in October, November, whatever, direct deposit it into my bank, withhold taxes, you know, so we'll do that automatically. Now, if you set that up, let's say to be done automatically in November, and let's say that year's required distribution is $7,000. And before November, you've actually gone in and taken out a bunch of money. Let's say you took out $20,000 to buy a car. Come November, we're going to say, oh, you have to take out $7,000, but you already did. So we're not going to send you that money because you've already met the minimum distribution. So that's why sometimes it's good just to have it done at the end of the year. So that way, if you don't need to take it, you don't have additional taxable income. All right? So it's very simple to set up. So is it in this book? Oh, okay. So there's something called the Uniform Lifetime Table that the IRS publishes. If your spouse is more than 10 years younger, it's a different table, but for most people, there's a Uniform Lifetime Table that you go to, and everybody uses it, whether it's us, Fidelity, whatever. If you're going to call someone and say, what's my required distribution, we go to this table, figure out what your age is going to be at the end of that year. So you have to start doing this at age 70 and a half. But let's say you're 72 and you just retired from URI, and you said, okay, I'm required to take a distribution this year. We'll go to a table, this Uniform Lifetime Table, and say, okay, at age 72, the IRS tells us to use this divisor, all right? So to calculate the amount that you're required to take out, we take the December 31st balance of the previous year, divide it by that divisor, and that's the amount you have to take out, okay? So if you do retire at 70 and a half, I'm sorry, if you are retired at 70 and a half and you ask us to take that distribution out, the divisor is 27.4. When you divide something by 27.4, it's a little bit less than 4%. So you can estimate that that first year you'll have to take out a little bit less than 4% of your previous year's ending balance. Okay? Yep.
Does it accumulate if you don't have to take it when you're 70 and a half if you're still working and you work 2 more years? Does your first minimum distribution include all the previous years?
No. So if you retire at 72, that's the first year you're going to have to take the distribution. Again, it's still going to be a smidge under 4%, and it's going to be based on the previous year's balance. But no, you don't have to go back and take more distributions. Basically, the required distribution is just there. If it's not obvious, it's just that the IRS is saying, you've had all these years to defer taxes. It's time to pay up. Okay? So they want you to take money out whether you need it or not. Did someone else raise their hand? No? Okay. TI interest only. TI traditional is generating interest, and for some people who have been putting money in there since the 80s and 90s, it's sometimes close to 5% interest that you're earning on that money. Pretty nice amount. And so if you had, let's say, $300,000 in there, and it's generating, let's say, 14% a year. I mean, $14,000 a year. What some people do is just say, hey, you know what? It'd be nice to just kind of keep the principal the way it is. Send me that interest, and we'll go take a trip or whatever. So if you use this option, it has to be started before age 69 and a half, all right? After that, you can't initiate it. It can continue after that, but it can't be started after that. I'll save the annuity for last. The cash withdrawals, again, most people will take what we call systematic withdrawals. You figure out what you need, you tell us, hey, send me whatever amount per month, and we'll just direct deposit that for you. The IRS requires us to withhold 20% taxes, and we'll report that to you in January saying, all right, you distributed this amount of money, we withheld this much in taxes, and you may get some of it back. when you file your taxes. No different than your W-2. If you live in Rhode Island doesn't require us to withhold state taxes. You will owe it, but they don't require us to withhold it. Massachusetts does require us to withhold it. So we'd be happy to withhold 5% or whatever you tell us to withhold for state taxes. All right. Where's the thing? All right. The annuity, there's a lot involved when you annuitize. There's a lot of decisions you need to make. Do I want to get an annuity just on my life? And if I die, it's done? Do I want to take a joint and survivor, where if I die, my spouse would continue to get money? Do I want to choose what's called a guarantee period? A guarantee period is strictly for the beneficiary. So if you set up a single life annuity, if you're not married and you say, I'm just going to set up an annuity based on my life, if you set up a guarantee period of either 10, 15, or 20 years, then TIAA will continue to make payments up through that 10 or 15 or 20 years. Usually if you're, in your 60s or late, before 70 and you ask for a 10-year guarantee, it's not going to change the payment that much. But the more robust set of features you ask for, the more it's going to reduce your benefit, right? It's just a numbers game. So if you're a single person at 68 and you ask for a 10-year guarantee and you die somewhere before the time you turn 78, we'll just keep making those payments to whoever you told us to make them to. If you live beyond 70, if you live to 100, we'll still pay you, but the guarantee period is gone. Now, if instead of a 10-year guarantee, you ask for a 20-year guarantee, then the payment during your lifetime will be less because you're asking for more features. Okay, so you just want to think about it that way. The more you ask of us, the more features you ask for, the more it's going to reduce your payment. Again, I hate to keep plugging the retirement income planner tool, but all of that stuff is covered in there. So you just say, I want this, I want this, I want this, and it'll tell you what the amount is that we would project that you would get. Now, when you annuitize, you can annuitize either from your fixed investments or your variable investments or both. A lot of times people they want safety, they don't want to worry about the benefit going up and down, so they'll move whatever amount they want to annuitize into their TIA traditional. And they'll say, okay, what will I get if I annuitize, some amount, $300,000 for my TIA traditional? We can tell you what that would be. The annual benefit could go up or it could stay flat. In the last 20 years, the monthly benefit has gone up 14 of those times. The other 6 times, there was no increase. Okay? What some people will do is they will annuitize from their stock investments. And the reason for that is to try to keep up with inflation or keep ahead of inflation. So if you annuitize either in part or in total from the variable investments like CREF stock, hopefully when the market goes up, your benefit will go up. And we'll tell you that once a year. It gets renewed, I think, in May. In a year like 2008, when some bad things happened, people got a letter saying your benefit's going to go down $300, $400, $500 a month. So that's not a good letter to receive, but it's because the underlying investments that are supporting those annuity payments are in the stock market. So the payment that you get is going to be reflected on the ups and downs of the market. Okay? Not saying not to do that. It's a really good idea to take some percentage of your money and annuitize from variable, but I just want to make sure you understand that there's some downside risk to that as well. Okay?
Thanks, Dan. I just wanted to mention one thing. I know this is a lot that we go through with the annuitization and all the different factors. The most important thing before I get into the slide is Dan said you have the retirement income planner on there, is what we do and our colleagues do and throughout the country is educate our clients. You know, what is this TIA traditional? What's this annuity? What are all these factors that I can do? What's best for me, my family? Because this is not an easy decision. It's a lot of time we go through, and it all goes back to even, you know, the budget. You know, getting back to this sheet to be able to do that. Because if you say, I need another source of guaranteed income in addition to meet my expenses and my, you know, wishes to travel and so forth, where are my options? Where can I do it? How I'm looking to get, and this is a way to determine. We can figure, you might say, I need an extra $500 a month guaranteed. Where can I get that from? So we can go through the retirement income planner and build that into the program for you. So just educating. And speaking about taxes, before I forget, the tax chart was in here, I'm sorry. There was some changes to the tax code last December. I have back there some tax guides on there. This has been a very hot commodity in our office because there's been a lot of changes on there because I think a lot of people think that taxes are going to change to some degree for this year, but it's a great point on there. So I have them on the back there and I can hand them out to you after the presentation. So, but let's talk about other types of investments outside of most of our clients. Most of their retirement savings are in a 403B or some tax-deferred vehicle. But you obviously have other other investments, i.e. in taxable accounts, whether it's through government bonds, municipal bonds, mutual funds, annuities that you can actually get outside of our retirement account. But they're going to, the variable, it varies. You know, you have the different volatility within different investments. You know, bonds tend to be a little bit more safe than equities. Equities will be volatile. We know that. We see the market, what it's doing this year. But I think the other part too is you also have to evaluate how much should I have in each one of those respective buckets. Should I keep so much in cash? Should it be in bonds? I hear bonds are bad, interest rates are going up, don't buy them. That's not necessarily true. But anyway, are different volatility, and so there are different vehicles. I think the other part too is that you can take periodic distributions. So when, as Dan was mentioning earlier, within your IRA, when you turn 70 and a half and you finally do retire, once you stop, the IRS forces you to take that money out. You can take these distributions out at any point in time, as you see fit, for whatever need to be able to do that. So you have a lot of options within there. Also, too, you can take it in a lump sum. Typically, when you're retired, your income does go down. Capital gains taxes typically, historically, have been less than income taxes, and they were just reduced back with the Tax Act. So there's an advantage there to be able to do that. And you also, we want to make sure that when you can incur capital gains. So we always, as Dan said, we're not tax accountants, but we always we look at cost basis, be sensitive to taxable investments, where you're pulling those out from. We want to know what the cost bases and talk through that with you and involve a tax professional if you use one. The other part of the advantage of this is there's no minimum withdrawal age. You can take money out of your investment accounts at any point in time. So, some annuities will have certain surrender penalties and so forth, or other investments. We want to be cognizant of that. We can talk you through that and look at that and see if it's the best option. And again, no mandatory distributions. The thing is with the withdrawal ages and the mandatory distributions, you want to be cognizant if you're looking at CDs. You don't want to obviously take money out of that account first, because there may be some penalties to do that. So you want to be certainly cognizant of taking any money out of there. Okay? Oh, no, right in front of me. Sorry. So, what to consider when you look at your retirement investments. The first point, what will the investment asset be used for? So when you're looking at your income and your expenses, so what is this for? Is this used to fund my retirement? Is it going to be used to fund my expenses? Is it used to fund other, future planning for grandkids or legacy beyond just that? So identify that. We typically look at different buckets. When you look at most of our clients have their monies in their retirement plans. When it comes out of there, whether it's through mandatory distribution or prior to mandatory, where does it go? What is it used for? How do we take it out in a very systematic approach? How liquid or easy is it to withdraw? That's, Dan was talking about, certainly with the TIA, when annuitization, in doing the transfer payout annuity, we know there's limitations there. So we want to be cognizant, where do we get money from first? You know, how much money should we keep? Typically, we recommend at least 12 months of expenses, you know, keeping it liquid in a liquid savings. So I know they're not paying great. Interest rates are getting better. But certainly it's something to be cognizant of where to pull that money from and be cognizant of taxes. Because the last thing we need to do is to give money, extra money to the government and to the state. They're not good money managers, as we know. How is each investment asset taxed on withdrawal? That's very critical. So we know from the retirement side, taking that money out, Dan mentioned it's 20%, and there could be some state tax implications as well too. But how does it come out? Where do you take it from? You know, which investment? Do I take it out of traditional? If it's in a general supplement retirement annuity, which is the liquid one, do I take it from my investment account that I have that's not in an IRA? So these are a lot of decisions where we can help with, but that's not the easiest thing to always people. Where do you take it from? When do you take it? You know, do I take it on the first of the month? I think the market will be higher in the first of the month. Maybe I'll wait to the end of the month with my interest credit. A lot of decisions that can be overwhelmed on there. What is it invested in? You know, what is the risk? I think truly understanding investments. What is this I own? What is this TIA traditional? You know, what can it do? What does TIA expect these investments to do this year? You know, what are the costs associated with that? Dan touched briefly on that about annuities, where sometimes people get, you know, I think buy annuities and they don't see the expenses that they could be paying with these guarantees. But I think one you want to know is understand the risk that's involved. That's why when we go through the planning process, you know, we have a risk tolerance questionnaire so we can understand. You know, we want to understand what your risk tolerance is, and in some cases, understand it. You know, certainly for both of you. I think that was, yeah, that's it. Oh, keep forgetting it's over here. I thought you took it from me. Okay, so really, you know, action steps. You know, we've got to kind of think about. We've talked a lot about today here what we're trying to accomplish and help you all with. But really, you know, estimate your required expenses. I think that's the most critical thing. You know, doing that budget exercise. You know, doing it with your spouse is critical, and I think identifying the must needs, and then also I think it's also to put discretionary. You need to have that discretionary put in there. You've worked in your entire careers very hard. You want to be able to have that discretionary spending. Identify a few things on there to be able to do it, but at least we know what income is coming in to be able to do that, and to determine, do we need to have guaranteed income? Right now, we have one source of guaranteed income that's going to be coming in because your paycheck stops. The Social Security is guaranteed. Where's my other source of guaranteed? Does that make you feel comfortable? Because as Dan was mentioned earlier, you could have investments in variable types of investments, even if it's in a utility fund. It's very safe, but still can vary from year to year, from day to day. You know, estimate the costs you want in retirement and consider investing accordingly. So once we help you understand your risk tolerance and what you're comfortable with, knowing your expenses, we can monitor your investments and have a plan in place. Because what you don't want to do, Dan touched on a little bit briefly about 2008, if you weren't monitoring your investments along and understanding what they were, but where should I be? Should I have half in CREF, half in traditional? I hear that a lot. And it's worked out okay. But now we know there's some limitations with traditional and et cetera. Understanding those and having a plan in place to be able to do that. Plan your income carefully. You know which assets, you know, when am I going to pay? You know, everybody's, you know, a lot of our clients say, I have my Social Security comes in at the end of the month, but I've got bills coming in on the end of the month. You know, when do we need that, have that income coming in? Maybe it's for certain things, you know, that you're trying to do. I had a client that was, you know, setting up a trust for one of their grandchildren, and that bill came in at the end of the month. They wanted that to be set up. We can do that. We can plan these things accordingly, you know, have flexibility to be able to do it. Taxes, taxes, taxes. One of the things that when I go through this budget exercise with clients, and I've been in the business for a long time, people forget the taxes as expenses. Most people just, oh yeah, that's right, I forgot about taxes. Because a lot of it is already paid. You pay your tax, whether it's through Social Security, it comes out, or it's a distribution that comes out of your account. We already send 20%, you know, to the government. So think about that as typically the taxes. And then learn about consolidation options. What we want to do is make sure you understand all of your options to be able to do that. Some people say, how are you going to figure out, I've got all these different plans, you know, where am I going to be able to figure out my distributions, where they're coming from, you can, in some cases, consolidate to be able to put into one to make your life easier. And then in some, you know, as we all get older, chances of health events can rise. You know, and something happens to a spouse, you know, do you want to call 7 or 8 different places to all of a sudden find out what the mandatory distribution amount is, or to understand what that is? And I'll just mention one last thing, and Dan touched upon it about beneficiaries. One of the things that we also, I know some of you I've talked to in this room, power of attorneys. We have an internal form. This is not a legal form, but if something happens to either one of you, go online, make sure there's a power of attorney named on file. So if something did happen, that you're able to have that person call in and say, listen, you know, Justin's sick, he can't talk, he had a stroke, here are some options, you know, that we can talk to that person. Because if you did have a regular power of attorney that was done locally, great, but how are we going to know that? We can't, you know, so that's another critical thing of basic things of planning. I mean, it happened in my family where my mom had a stroke. She couldn't talk the next day. None of us 4 kids could call the bank and find out if the Cox cable bill had passed or anything else like that. It was kind of frustrating. So, questions? Well, it's so through the planning process. So we would know. So if you have, say, so if you're I'm guessing you say, for Justin, if I retire in 5 years, or whatever that time is, we go through the planning process. We'll estimate, okay, Justin, I want to retire in this June or next June, whatever that time is. What are my options? So we'll ask you to bring in your Social Security benefit, you know, go into SSA.gov. So that's the first option. And then we'll understand where we can take, so that expense number can give us that number. And the other thing to mention about expenses, you get into retirement, most people say, okay, I know here's my mandatory, I need $5,000 a month. 6 months into retirement, it's a new thing, it's a great thing, none of us have been there. Wow, you know what, I only need 4,000. So, but we need a starting point to be able to do that. Does that answer your question? Okay. Any other? Oh.
So on this slide, there's a couple things I want to point out. First of all, I mentioned the Retirement Income Planner tool probably about 12 times. I realize that. The other tool that we use a lot that is also available to you when you log in is Retirement Advisor. So Retirement Advisor is more for folks who aren't at retirement yet. And the question there is, am I on track? Am I going to be okay? And it'll come back and either say, well, if you're not on track, here's what you should do. Maybe work a couple more years, save some more money, whatever. And then the second part of the output on that is actually allocation advice. As an individual, I can't give you allocation advice. I can't say you should put your money here, here, and here. I'm not allowed to. But the advice that's generated by this Retirement Advisor tool is objective third-party advice. It's from a company called Morningstar. All right? So again, you can either use this tool and the Retirement Income Planner tool on your own, or it's one that we use as well very often in our meetings. All right? The second one here, this tiaa.org/PFR, I will admit that I didn't realize that was there until I looked at these slides. We've got a ton of information on the website. It's great. PFR stands for Planning for Retirement. And I just started going through there last night. There's just a lot of good information in there about Medicare, Social Security, just lots of different topics, right? The annuity options that we covered, that's all in there. So I would check that out. And then the last thing I would say to you is if you do want to make an appointment, you can call our 800 number to do that, but the easiest way to do it so that you know you're not going to be on hold is to go to tiaa.org/schedule now, one word, schedule now. And you can see the calendar on there and see what time slots are available and just set your own appointment. So, all right. Well, if there's no other questions, like John and Pat said, we will stay around if you want to talk one-on-one. But thank you very much for coming, and good luck in retirement.